We're live.
Okay, and this says I'm going to say welcoming things to all of you, so welcome to all of you. Stay warm. And this has been a long haul, and I think this is the final chapter. We've got both of you, Abby and Julia, you're gonna come up and walk us through final report. Computer's very cold.
Oh, you're so far
I
away.
can get up here and it's
What is that?
down, it's a bit of ice on it. But
It's like Putin's table.
yeah, I didn't have to open the door and climb out to get in the gate.
That's actually why I was late. I forgot that I would have to scrape off my windshield.
Yeah. Okay.
You were so far away. What is happening?
Yeah.
Do you have a microphone too? I don't project or anything.
I'm sorry? Is it?
Could you just come up, come and sit on
Yeah.
the,
Yeah.
Sit up here
because the
close.
cameras aren't adjusted for you being that far.
Looks better.
There you go.
So I will start us off. For the record, Abby Shepherd, Office of Legislative Counsel. The report is the document we're going to walk through or talk about today. There is no additional documentation because we wanted to make sure that everyone was aware of everything that's in it. There is an executive summary. There is currently no conclusion because we were leaving it open for what the committee wanted to put in the conclusion after today's meeting and after hearing from stakeholders. So to jump right into it, the second page of the report does lay out the table of contents. The first you have the executive summary, then you have the enabling legislation. The way that this report is structured follows more of the different major points that the committee looked at and considered, and then how it would actually propose to structure an education income tax. All of the charges within the enabling legislation are addressed, but they are not their own specific sections. So if you wanted to change that, we can make something more explicit saying, you know, this is the part of the report that addresses that issue, but each of them are addressed in different places within the report. So as you recall, the enabling legislation created this committee to look at how an education income tax would be imposed. It in subsection C of the enabling legislation, you were required to look at restructuring the renter credit or creating a new credit, transitioning the current homestead property tax system, the entire system, to a new income-based education tax system, how modeling would be carried out given the differences between household income and adjusted gross income when looking at an income tax. One of those charges was whether there should be a cap on the amount of income subject to a new tax. And then any challenges or other administrative issues with administering a new proposed tax. And finally, looking at income as a tax base and how that might impact the general fund. So again, those are addressed throughout the report. There isn't an explicit pointing to each of those. There's like a heading that you can look to, but that is something that could be set out differently if you chose. Back to page 3 of the report. This is the executive summary. So this is all of what came out of your last meeting's discussion. We had walked through that bullet pointed list of how a tax would be structured and how it would be administered. Something that was pointed out within this first paragraph here that could be changed, that, you know, there is some punctuation here, but something that had come out of a few of your final meetings was that, and I believe this was Senator Pearson's point, that the charge was if an education income tax were imposed, how should it be adopted? So that was put right in the very beginning of this summary, because this report does not debate that whether it should happen, it's how it would be implemented.
If.
Just on our process, do you want us to comment as we go. I sort of made my notes for myself as I read it. Do you want to go through and then come back to that? What would make sense?
What would work best for the witnesses? Would you like, I don't know, Emily, do you have a?
Whatever works best for your
Yeah.
process, as long as we'll get through it. I just want to offer that Senator Perchlik sent in some very detailed and good line edits that Julia and Abby already have and are planning
Okay.
to incorporate, but are not incorporated into this.
Okay.
Okay, so would it work for you to get,
I think that's great because
Okay.
it's 30 pages with the appendices. If, as we're going along, there's something that you see that you want us to, sort of like if we're doing a bill walkthrough, and I'll note it and we'll make sure that that gets changed.
Well, given that this appears a few times, this last line of this very first paragraph, the committee has no consensus recommendation regarding that sort of implies that we were asking that question and didn't arrive at consensus. And I don't think that represents our work. And so I'm wondering about just that. And basically this sentence appears a few times. So I would like to see us just tweak that in some way. I mean, I can come up with an alternative, but does that make sense?
Yes, and that is certainly there. We talked about how to frame it in a way that captured the different discussion you had and trying to make it as neutral as possible. Would you like to say something more along the lines of the committee did not make a recommendation?
Well, again, I mean, that's sort of an assertive, we weren't asked to make a recommendation. We didn't talk about whether or not to make a recommendation. So I just wanted to, if somebody reads this in 5 years and doesn't have the desire to watch all of our meetings, I think, I don't know but how it would be structured. Yeah, the committee set aside, didn't try to.
Or was not asked to.
Yeah. Something that just reflects it. I mean, I do think we have a mix of views, but we didn't try to hammer through that. So I don't know.
there were other considerations we
Yeah.
weren't charged with and didn't get into?
Yeah, so.
Because I think a few of those scenarios, a few of those bits of language could imply that we debated and then chose not to make a recommendation, which is something that often happens, but is not what we did.
And was not part of your you were not charged.
We were not charged with it,
Make that clear.
therefore we did not
I would just say, the committee was not charged.
recommend.
We did not.
Yeah, there you go. I like that.
Yeah,
I mean, we were charged with make recommendations regarding the creation and implementation. So it seems like we could have made a recommendation of saying, you should do this. You should create this. That would have I don't think anybody would have said that was outside of our.
Well, but we didn't have, I just don't want it to look like we tried.
No, I agree with you.
Right.
I'm just saying,
Yeah.
I don't think we can say that it wasn't part of our charge. We can just say we didn't attempt to come to it.
could say within the time frame that we were given, we were not able to investigate whether or not we should. This is, if the legislature at some point decides to do this, this is what the recommended structure would be.
About the committee decided not to. try to-
Chose not to.
Chose not to.
Yeah,
Recommendation.
that's easier.
I think if we wordsmith sentences
Yeah.
so long, we will never leave
Never.
this table.
You get the sense.
And so they understand our point.
Yes,
Okay,
Yes.
That is an important one.
it's a very important one, yes.
But that's a good point as well.
yeah. We just didn't get there. Okay.
With lots of notes on changing how that's presented in that first paragraph. The next part of the executive summary pulls out pretty much all of what's bolded throughout the report as the clear recommendations that are being made by the committee. And then this sort of references the rest of the report to get more detailed recommendations. And there are some further very much in the weeds recommendations that we left out of this list, particularly regarding withholding, because it really gets into the administrative nuts and bolts. So the primary recommendation is that an education tax should be imposed, should be structured with progressive tax rates and income. And I'm using the word should, but just because it's a recommendation, that's assuming if this happened, it would be an education tax structured with progressive tax rates and income brackets on the adjusted gross income of all Vermont taxpayers. This doesn't go into the detail of what all Vermont taxpayers means, what adjusted gross income is, and how those income tax brackets and rates would be set. It does talk about the rates in terms of them applying by school district and being increased or decreased according to local education spending, because that was one of that was, I want to say the bulk, but that was a big part of your discussion of how to continue to allow for both local education spending decisions and having an impact on the tax rate, sort of your skin in the game scenario. We did put in the detail about that adjustment being calculated compared to the prior year's statewide average education spending. That's how that increase or decrease would be determined. The current structure and timing for setting tax rates, the committee recommended maintaining that. So that has the December 1st letter still coming to the legislature, and then the legislature making decisions about actual tax rates that are set after budget decisions are made in March. And that also allows for, or recommends that the legislature would continue to balance the education fund to meet education spending by using what the committee was referring to as flexible levers, both with the education income tax rate and the non-homestead rate. And so that would adjust for also other revenue streams coming into the education fund, like sales tax and meals and rooms tax. The withholding and estimated payments are recommended to be maintained, to be created in a way that maintains the same structure that's used in personal income tax, so that it would sort of piggyback onto that existing structure. Would also require estimated payments the same way that those are due on income currently for personal income tax. The existing renter credit program would be maintained, would be intact. No changes were recommended to that credit program. However, a new non-refundable credit for all renters against the education tax would be created, and it would be structured as a percentage of gross rent paid. The non-homestead property tax would be maintained with some changes. So the structure and its administration, so it would still be a property tax administered at the local level in terms of valuation, billing, collection, all of that would be maintained. The committee did recommend to expand the base of the non-homestead tax. So for a home, what would be considered a homestead property, only the dwelling and the 2 acres around the homestead would be exempt from property tax. Anything above that 2-acre parcel, whatever is part of that property, would be subject to the non-homestead. So if you have an 8-acre property, the house and 2 acres would be exempt. The 6 acres would be subject to non-homestead tax. The amount that would be set aside in the stabilization reserve would be increased. And there was discussion about the increase in the volatility to the fund, given the shift from a property tax base to an income tax base. So there was a recommendation to increase the stabilization reserve to adjust to that new volatility. Education payments.
Just on that question, this is set out as a very factual statement, and I'm wondering, it's certainly been asserted repeatedly, but I'm wondering if we would say due to the possibility of decreased stability, I don't, we haven't had any way to totally verify it. Obviously, income does move up and down, but I don't know what people think about that.
That's fine for me.
Yeah, it's fine by me.
Possibility or likelihood? Is that too?
Well, likelihood is an implication. I think to me, it's still a question mark. It's been asserted by people, but so, I don't know. Possibility would make more sense to me.
Okay. No one objects.
Noted. In terms of payments and cash flow from the state to school districts, the committee had recommended to maintain and follow the same timeline and administration of those payments. And lastly, the municipalities, because they would still be administering the non-homestead property tax, that their involvement would not change. So they would still be valuing, collecting, billing. They would be setting the grant list. Further in the report, there is also, and that's not included here, but there is mention of a few of the current payments that go to municipalities as payment from the state for dealing with the grant list and all of that administrative burden, that none of those would be repealed, that those would all be maintained, with the exception of those that relate to the homestead tax credit, because that would be repealed. So that is
Questions?
executive summary.
Okay.
Really good.
So we want to start wading through.
Are you ready for?
Yeah?
A deeper dive. The next few pages, and I don't know how much detail you want to go through for the overview, because this really lays out the existing,
I don't know that we need to go through the enabling legislation.
right, that's sort of our.
An overview and background perhaps.
I just had wanted to point out that subsection C so that you know what your charges were and that they are addressed throughout the report.
Okay.
Starting on page 5 is an overview of the existing education finance system that explains the Brigham decision. It explains how the property tax rates are set now. It explains how the education fund is funded, the revenue streams, and then the property tax credit. My understanding from some of the comments that I've seen was that there wasn't much to this, if I'm remembering correctly.
No, this is.
It's just describing what is.
Exactly. That's.
Yeah, this is pretty standard in terms of including, and we've written this up in other reports to provide that base level of knowledge for people to be able to understand. The only section I would include, which is a little bit different than, well, maybe not different, but under the education fund, we did include that portion of the necessity of adjustable tax rates, which lays the foundation for those adjusting the tax rates in the future. That conversation that the committee had on page 7 is that groundwork. But
Okay.
On page 7, there's the paragraph about recent legislative changes to education fund expenses. And am I jumping ahead, or that's sort of where?
No, so feel free, because this section is, we have the overview, then we have expenditures, and then we look at how it's funded. So going out and then what's going out and what's coming in. The recent legislative changes are included both on page 7 and in terms of obligations from the education fund. And then there's also a recent legislative changes on page 10 to show what's been coming in. That was presented to you in one of the meetings. That's why we'd included it there, but pared it down. And then there are a lot of sites.
an appendix 4 offers a more detailed list of recent new education fund expenses.
Yeah, I guess I just, if I'm trying to read this sort of without some of the knowledge, and I'm hardly expert in ed fund, but it just sort of has this feeling of being, it makes the prospect of our report confusing. Like it's sort of, I took it to be like, hey, there's been a ton going on, tread carefully. And that seems more like a legislative committee function in terms of weighing it. I don't know if I don't mean to be fussy. It's just was my reaction. And I wondered if other people, what they thought, or if this was sort of necessary. You know, the Wayfarer, this stuff on page 10 is much more about the known impact to the ed fund, whereas we're sort of about to move into a period of understanding these other changes. I don't know. I kind of wondered if there was a way to flag it just a little more generally, but maybe
Okay.
as you can tell, I don't have a.
Anybody else have?
I think it's sort of solidly balancing the long-term changes we've made and doesn't get into the details of some of the short-term things. So it works for me. I think it is important context about what is happening in the future that I think we will need to take, that a committee would need to take into account.
Right.
Including, I think, this issue is championed by some folks who are not as deep in the weeds on the Ed Fund. And so I would want them, if they were going to sponsor legislation in the new biennium, to have this context going into those conversations.
Yeah. Okay, that's fair.
Okay.
It is also split out, because we had divided this overview into the ins and the outs. I don't know if
Okay.
that would provide more context if they were next to
That's the outs.
recent legislative changes.
Okay.
There is, starting on page 7 into page 11, page 10, that explains the calculation of property taxes, the property tax credit. Again, this is all what is. It explains the yields when calculating the homestead property tax rate. And then the very last section is recent legislative changes that increased education fund revenues. Moving on to the next section is the principles of a high quality tax system on page 11. This also is sort of an abridged version of what was presented to the committee, and there is an appendix, just looking, 5 on page 33 that lays out all of the principles in more detail as were presented to the committee.
I'll just flag that the second paragraph there has that consensus,
Yes,
more
exactly.
like did not study weather or whatever.
So that can be aligned with that first paragraph in the executive summary. We'll reword that. The next section, section 4, starting on page 12. This is where the meat of the recommendations are being made, and this is what the committee recommended to adjust. Considering adjustments to the property tax credit, I think I'm skipping ahead, I'm sorry. I just completely skipped ahead. Sorry. So this was part of the committee's work because you did have 1 or 2 meetings where you did a really deep dive into the existing property tax credit as one option to address some of the concerns about progressivity and the tax burden. So do you want to steer this discussion? Or you want me to keep going?
I think you're doing great unless you'd like me to.
No, I'm happy to keep going. So again, because the committee had decided not to adjust the existing structure of the property tax credit, this is a very pared down version of what you had seen in committee.
Right.
This really summarizes what you considered and then that you decided to make no recommendation. And again, we spent a lot of time trying to parse this in a way that you considered it but decided not to, in this context, recommend adjusting the property tax credit.
This was Representative Beck's suggestion, but that we just move everything up the income ladder, which would result in a much higher rate at the upper ends. And that didn't work out the way we'd hoped it would. So we went back.
I have a very fussy piece of feedback about this, and I'm owning that it's fussy. This is the only place in the report that red is used. And so it really stands out a lot as like a big warning in the midst of the report. And so if it is not too much trouble to make those gray circles rather than red circles, I would really appreciate it.
Wow.
I named.
And you thought you-
Now I'd like a less fussy comments. I'm curious, the bold line, the committee makes no recommendation on adjusting the income system.
Me too.
That is true. We didn't recommend changing it, but we did sort of reject the structure. And I wouldn't want us to say that we studied it in depth and said this was not the approach, but we did sort of move away from that. And I wonder if my notes said weren't impressed. Just something that indicates we did kick the tires on this one.
It didn't
sort of
accomplish
match.
what we wanted it to accomplish. But I'm not remembering the exact graph that,
I think from my perspective, it would be helpful to have a bit more guidance with respect to what the committee does or does not recommend. When we were drafting the report, we were really just trying to capture specific recommendations or lack thereof we had heard the committee make. So we don't want to put words on the committee.
I wonder if
Did
that,
not endorse.
Well, we sort of decided to go in a different direction.
Yeah.
It wasn't assertive.
I think we decided that these tweaks would not accomplish the goals we had set before us.
yeah.
Was that?
So my hesitancy there is because we, earlier in the report and throughout the committee, I'm not aware of specific goals that the committee recommended.
I had been thinking that we haven't listed goals.
So when we drafted the section regarding principles of a high quality tax system, we referenced in the third paragraph that committee discussions frequently focused on the tension between the pillars of simplicity and fairness, because that really seemed to be where the committee's conversation came back to. And we didn't cite further what the explicit goals were.
So I wonder if it could just, I am wordsmithing after I said we shouldn't wordsmith, but something to the effect of the committee recognized, decided, et cetera, that these tweaks would not improve simplicity or fairness of the system, and so went on another track or,
Yeah, that,
When you say tweaks, you mean adjusting the incomes?
yeah, I don't want you to use the word tweak in the report, and I think this is how I'm not wordsmithing.
Can I just say, how many pages is 34 pages? We're going to spend all day
yes.
picking apart a sentence or two. I think the report is really good. I think it reflects what we've done very well. I'm excited to hand it in. So I just want to say.
Thank you.
And now I will suggest.
And now you'll pick. Okay. So we've decided we're not using red, we're using gray in the circles.
We're a different color, right? Is it okay if it's not?
No, green would stand out too.
I'm happy to make them gray.
All right. So that we're still in section 4?
Yes.
Yeah, okay.
Looking at and summarizing trying to address, or find ways to adjust the property tax credit for the goals of simplicity or fairness. There were 3 areas that were identified, and by modeling those and the conclusions that came out of that modeling, the committee decided not to go that route. So we can it lays out what the 3 sort of issues were, that there are cliffs and bumps for people with lower household income. There's that hump, these are all your circles for household income over 90,000, and then the low effective tax rate paid by taxpayers with higher income. And JFO's analysis pointed out that these are in quotation marks, appropriate here, pushing on the balloon. When you try to solve those circled areas, you tend to create other bulges and other issues. And that was sort of the complexity that the committee decided to move away from. And also trying to address those with broad strokes is the sledgehammer, which ends up creating other issues elsewhere. So I think the final paragraph summarizes those 2 issues. And again, there's that final sentence, it's not bolded, but we can make sure that that reflects the committee makes a recommendation for any adjustments. It can be that the committee decided that adjustments to the property tax credit would not reach those goals or achieve the principles of simplicity or fairness.
I think
Words
that
last.
last paragraph does sum it up.
And then I believe that's in the appendix.
Because we reached a point where it wasn't even debatable. We just said, gonna work.
So if, just noting it does not, we did not include an appendix on this, but all of this, there are references throughout this and footnotes directing readers to the committee webpage. If they wanted to see those.
All those graphs.
They're all available.
Okay.
Okay, now section 5 is the meat of the report and the recommendations on how to structure an income-based education tax. The summary does start with that caveat of after deciding not to recommend adjusting the property tax credit, the committee explored options for actually implementing an income-based education tax. Again, it's repeated that the committee did not consider the merits of imposing it, rather how it would or should be structured, how it would be achieved if a tax were imposed. So the primary recommendation is creating an education tax structure with progressive tax rates and income brackets on the AGI of all Vermont taxpayers, and the rates would be adjusted by school district spending compared to the prior year's spending, statewide average spending. And then the rest of that section goes into great detail. Yes.
On Chris's point, there's a small question on the second sentence of that summary of recommendations on whether we considered it. I kind of felt like we did consider it but we just said, well, that's not what we're not going to try to figure out whether it's the merits and demerits of doing it. Mm-hmm. So I don't know if you saw that edit that I suggested. I don't know if others agreed.
Yeah, I mean, I
consider it, but we were like, okay, that's not what we're going to try to solve, we're not going to try to weigh the pros and cons of it. We're just going to say, okay, this is how you would create it if you were going to create it.
Yeah, I think I agree with that comment. We did consider it, but that wasn't what we worked on.
Right.
Yeah,
That you prioritized how as opposed to.
I think
As
so.
opposed to should,
Yeah,
because should would take a whole lot more meetings.
Yes, and one of you had mentioned leaving that up to the General Assembly, so I can put a note in there as to leaving that to the discretion of the committee process during session. So the first sort of subsection within section 5 looks at tax rates and how they would be set. So the first subdivision within this section is progressive tax rates and income brackets. The committee was clear that the education tax should be structured in a progressive way, like the personal income tax. However, there was not a set recommended rate or rate structure or brackets. There were some that were proposed. They are noted in a footnote here because of all of the complexities, especially creating a new renter credit. The actual rates were not determined through this process. And there is I'm sorry.
So I wonder if people would join me. I'd like to see us offer a very stipulated structure, not just sort of put it in a footnote. And you know, and I think it clearly needs more research. It clearly has, you know, A, B, and C that we're not precise about and would need further understanding. But this topic has been debated since the 1990s in some fashion, if not before.
yeah.
It's, you know, people have put it on the table in different ways. We've now had, you know, it's been a buildup in the last, by my observation. I mean, I was part of a tripartisan coalition in 2007 to put this on the table. We had the report from the tax committee, 3-4 years ago, that Deb Brighton folks looked at it with the weighting. So if we come forward with something that doesn't have at least one model to try, I feel like we're undermining the work we've done. And I would not want to say like, here's what you should do, but I think the value in the discussion that that at least I'm trying to create through this work is greatly undermined if we don't say, that here is a way it could be done, understanding we need to figure out A, B, C, D still, and the data is perfect. I don't know if I'd just like to see us discuss an option or something like that.
I do have some concerns about the idea that if you put numbers out into the world, people don't read the paragraphs around them, and then it becomes truth writ large. And I agree with you that a reference point is helpful. And so I wonder if including a couple of the graphs or tables that we're maybe going to look at this afternoon. Nope, later this morning. Just sort of like, this is what rates would look like with this model. This is what rates look like with this modeled. And then by including more than one rate table, we make it clear that this is still like, there are still policy decisions to be made on these rates, but this is sort of a reference point for understanding the conversation.
I guess where I have, raising 474 million is the first one. Is that what we raised this year? I mean, to me, the starting point, I know what my property tax is this year. If we raise the same amount of money we did this year, this is what the income is. Does one of these, I assume one of these tables reflects that, but I don't know.
So when we went to model the rate structure, and this was the reason why we didn't include any of the rate structure or specific numbers, because we took the net, I would have to check my notes, I don't have them in front of me. We took the net homestead property tax for 2022, 2020, I'm not sure, for one of the most recent fiscal years, and created a preliminary first pass at what a potential bracket structure and rates would look at. It was very preliminary. It was based on initial modeling. We didn't hear guidance from the committee regarding the number of brackets, the steepness of the slope, what those rates looked like within each bracket. And then the following modeling has really just been raising different amounts of money, what a potential rate structure would look like. That being said, there's different ways that those rates could certainly be calculated. And it does depend on a number of the outstanding points that are still would need to be made, that are outstanding questions that the committee didn't have enough time to address.
Yeah, it depends on a lot of things. This couldn't go into effect because we've still got weighting hanging out there. And we specifically asked not to put one in for exactly
That's correct.
the reason that people would focus on it.
What about
without the kind of representative
Yeah,
back?
I think so. I think you don't. If what we're talking about here is whether we should, message to school districts what their tax rate would be. Is that what we're talking about here?
No, this is the charts. They're in the appendix that we've got, or the follow-up. What the tax rates would be if we raise 474 million, if we raise 600 million, because the schools aren't going to have a property tax rate now. Individuals are going to have an income tax rate.
But it's tied to their district's decision.
It's tied to a district
Yeah.
decision.
Right.
So,
Yeah, I think the only thing I'd want to show is that, like, if we follow current law, in the, all the other revenue streams, we know that we have to, whatever it is, $474 million. And I think that has to be our assumption.
if we'd done an income tax, where did the 474 come from?
Right, so the 474, it's difficult to, I just looked at my notes. It's difficult to model in Cambridge and raise like down to the point, whatever, million
Okay.
dollars. So it's between 470 and 476 for the previous two fiscal years, FY '22 and FY '23. So that's the net homestead property tax. So that's the gross homestead property tax subtracting out the property tax credit. Raising that 475 ballpark figure, the modeling in the brackets that we presented that raises that 474 did run through last year's local spending decisions. So we included the adjustments by district spending to raise those dollars. And that's how those brackets were calculated.
Okay,
That being said, that 474, 475, that ballpark number, that's not taking into account any exemptions. So the renter credit that the committee spoke about and we'll get to, that is not included. That's assuming that everyone with Vermont income is paying this education income tax. So my hesitancy in terms of including these rates is if we were to include the rates for the 474 in the report, that would not be consistent with other recommendations that the committee makes on the following pages.
Okay, so
regarding
put out-
additional expenditures.
last year, the top income surcharge would be 2.65. And then we subtract out the renter credit and we do this, and it turns out to be 3.21. There's going to be some people yelling foul. I mean, this isn't what you suggested I was going to be paying.
I wonder if it's helpful to have the conversation about including a table and what a table to include after we have Julia's presentation on the table she's going to present to us later
Okay.
this morning, because then we'll be able to understand the difference, because she's modeled with the renter credit.
We might just at some point say the committee is hesitant to put forward a table because there are so many variables out there, including.
Or we could just be really clear that we're communicating all the variables.
Right.
But I think we all need to understand the table a little better.
Okay,
There's also the question that was in the enabling legislation about whether there should be a cap imposed on higher income, if there's like a limit to the amount of income subject to a new tax. And there is a final sentence in this first paragraph that the committee did note that that's one of the variables. So if you were to impose a cap on the amount of income subject to tax, that would likely increase the rates for other taxpayers with lower income.
okay.
So I agree that there is a lot of, I want to say hedging, but a lot of explanation as to the rates that are in these two paragraphs that might be glossed over with a table to look at instead. So there's a lot of important information in these two paragraphs.
Yep.
In terms of the locally adjusted rates, the committee recommendation is to have a tax structure that adjusts an education tax rate by the school district spending. That would retain local control over education spending. It would have an increase or a decrease to the local school district tax rate based on what the entire statewide average was in the prior year. And that all assumes, this is also another actually variable that I could put up in this previous preceding section, is that this all assumes that the education spending definition is being unchanged. That is one of the assumptions made in the modeling. There is a table here provided by JFO that lays out the different ratios of how local tax rates would be adjusted.
You're on page 15, is that
I
right?
am on page 15, yes.
That's true.
All right.
I'm not sure.
Okay.
So that is the extent of that section. It really just points out, get these printed correctly. It points out that the rates would be sensitive to local spending decisions. If there were any.
That's not the table you were referring to.
Okay, and the bracket rates, so if it's average, then the bracket rates are the bracket rates, right? If it's below, then the bracket rates are 0.719 of the table rate we've got up there. It's lower than the table rate, and then it's up to 1.389. We got to round those somewhere.
That's correct. That's based on FY '23 education spending for equalized pupils.
Okay.
So my understanding is that the committee didn't set a floor or a ceiling adjustment, but this is based on the minimum education spending per equalized pupil in the state in FY '23 and the maximum. And then those would be the adjustments for the lowest and the highest spending districts.
Okay.
Do you remind me what mode is?
Mode is the most, the one that shows up the most. So I believe that this one showed up 10 times in 10 different districts, if I'm remembering correctly, but I did this a couple weeks ago, so.
So this graph right here on 15, these numbers are all based off of renters paying.
Correct.
Okay.
Is that true? This is just the band between high spending, low spending, and average.
Right, sorry, I should have been more clear. This would apply to if renters are paying or if renters are not paying. This is referencing those locals, the local adjustments.
But if the renters hypothetically didn't pay, these adjustments have to change?
No, my understanding of the committee's recommendation is no, because these are really the factors that adjust the local rates up or down depending on the local spending decisions. So what would change if we're using renters, are those base bracket rates?
Base rate would change depending on the income, the money that's coming in.
Right, but
How
the
much needs to be raised.
adjustments
Right.
would remain the
I mean,
same.
we could say the same if sales tax cratered or.
Yes,
Right, or if you decide
Yeah,
to
this,
exempt.
this is the spending side.
right.
It's the lay of the land on the spending.
If you find base rate and bracket rate to be synonyms, do you find base rate and bracket rate to be synonyms?
I'm using bracket rates here.
Yes.
Because there's multiple rates in different brackets.
So, yeah, this is what, let's say Scott and I both earn $100,000 and I'm in an average spending town, exactly average. And he is in a maximum spending time and his bill is gonna be 39% more than mine is.
Yeah.
That's right. I'm sort of stating that, but it really happens.
Yeah, I think that's true. Yeah.
And I'm just trying to think about someone reading this
Yeah.
other than us and if,
We're assuming all
If this
kinds
will
of
make
people
any
are going
sense
to
to them.
read this.
but that's, if,
I can try to add a few more lines explaining the table.
that would be great,
Sure.
including caveats about what you're modeling and such.
Well, but this isn't modeling. This is a factual statement of what happened in '23.
Right.
yes.
This is what your rates would do. Somewhere in here, we could just put a caveat that said, because this system and the presence, there are so many variables that these are our best estimates given what we know now, but they aren't written in stone. Anything could change from the national economy to,
Well, but
This is, yeah.
This isn't that. This is
Yeah, no, this chart is not, but somewhere here, I think our concern is if we put out something in numbers, that's where the focus is, and somebody's gonna say, but you said my rate would be. And then the sales tax revenue hits the bottom and my rate is suddenly 3 times what this chart said my rate was gonna be. And I think that's the concern, is that we are not telling people, if you do this, this is what your rate will be, because it's like Jell-O. I mean, it just.
On the other hand, if we don't offer some examples of rates, people need to compare it to
Right.
what their big property tax bill is today.
Yeah.
Otherwise, we're not giving them much. That's my worry, is that we effectively just sort of land with a dud.
I'm happy with this table. I just think a couple extra sentences explaining how people should read it would be helpful. That's all.
Would you put the date in the table title so that it's more explicitly
Sure.
based on our experience? Even though it's in the
Well,
bold.
yeah, and I think the explanation that if you make $100,000, 2 people making $100,000 living in an average town would pay the rate, somebody living in a high spending town would pay 39% more. You know, that's the difference. It's based on town spending, something like that. But
Also, Julie just made a good point that I will add a sentence saying that this assumes there's no floor or maximum on the adjustment as well.
right. Yeah, at this point, if the town is poor and decides to spend a lot, somebody with a higher income somewhere else is probably going to pay more. I don't know that we're getting away from that thought that I can do this and somebody else is going to pay for it. Thinking that we're concerned about now, you know, that, well, we can vote for it and it's not going to cost us anything more because we're all income sensitized.
I think it's a little off topic of this chart.
Yeah,
I'm realizing that we were planning to run through the whole report by 10,
and we've got
7 minutes.
7 minutes.
So the rest of the recommendations run through page 20, so we have about 5 more pages to go.
Okay, well, let's move. I think
Okay, great. So the next section is the structure and the timing for setting rates. So this does segue well with the discussion about local spending decisions. The committee's recommendation was to maintain the current structure and timing for setting tax rates, and using this new tax and the non-homestead tax rate as a mechanism to accommodate actual revenue. As Senator Cummings just mentioned, if sales tax is lower than forecast, then that would impact the amount of revenues in the education fund. The rates could then be adjusted following the same process as it happens now. But rather than having a yield, there would be the non-homestead property tax that could be adjusted, as well as there would be these statutory brackets and rates, but those could also be adjusted annually to make up for any shortfalls or overperformance of revenues in the ed fund. So again, that would retain the December 1st letter. It would retain the General Assembly's rate setting authority, and it would also retain local education and spending decisions. There's some other sort of in the weeds comments about the December 1st letter statute, how that would need to be amended, but I don't think that's really, it's more conforming changes. So I'll skip over those unless there are other comments on this section. Somewhat straightforward. Into the weeds of defining income. So the committee did recommend using adjusted gross income, and it would apply to the income of all Vermont taxpayers. So adjusted gross income is a federal definition. It does raise a few constitutional issues that are addressed in this report in terms of applying the tax to non-residents. The committee recommended applying it in the same way that the personal income tax applies to non-resident incomes. That's only Vermont source income. There is an exclusion for income that's not taxable under the US Constitution. Also an adjustment that is made to Vermont non-resident taxpayers' income. The adjustment applies to their tax liability. So it looks at the proportion of income received from out of state that's within that big AGI bubble versus what is actually Vermont income. And then the tax liability is adjusted proportional to those. Comparing those two numbers, that has been found to be constitutional by the Vermont Supreme Court. There was a writ of cert up to the US Supreme Court and that was denied. So that is a constitutional structure and that is the recommendation that I understood from the committee wished to follow. That would then apply the education tax to part year residents, residents and non-residents on their Vermont income.
Maybe that last sentence of that first paragraph of non-resident education tax would not be adjusted. That means like would be adjusted by the education. Is that what we meant by that sentence?
Exactly. So that local factor, we can clarify that
Okay.
more certainly. That's referring to the fact that because there wouldn't be district spending decisions of a non-resident, it wouldn't have.
They would just be at the 100%.
Multiplied by one. Yeah, assuming they are exactly at the average.
Right. Okay. Thank you.
Yeah, maybe we could state that as well.
Yeah, I can make that into a new paragraph and add a line or two of further explanation.
And also this, I could add this in, I did not get into the difference of AGI versus taxable income. I did provide the link to the presentation that was given on the different types of income, but just again, so the committee is aware, AGI is a larger number than taxable income. This would not pull in all of the personal income tax, taxable income deductions, exemptions, et cetera.
Okay. Are we on to withholding?
There is one section on the cap on income that is bolded and sort of set out as one issue because that was part of the enabling legislation. That was one of the charges. So the committee does not make a recommendation, but did consider whether a cap should be set. Some of the advantages and disadvantages are listed here. So on the one hand, a cap would limit the tax liability for individuals with higher income, which otherwise the tax liability could be, infinite depending on how large their AGI is. On the other hand, setting a cap, as mentioned in the rates section, would require other adjustments to raise the amount of revenue needed to fund education spending. There are a few notes there, but no recommendation from the committee.
Sort of similar to whether we should do this or not. I felt that the reason we didn't make a decision on this was that we knew that the legislature would debate it endlessly, whether we made a recommendation or not. I don't know if folks want to add that context in or not. I don't have a preference myself. I just want to offer it.
Are you saying just make it very explicit that we're punting this because it's fruitless for us to make our own decisions?
Yes.
You're going to have to debate it.
You're going to do it anyway.
Yeah.
I think everybody understands that.
Okay. Cool. Great.
Yeah.
Rely on the expertise of the requisite committees.
That's going to happen anyway.
I think that's a little
Okay,
flattery.
great.
Okay. We've got 2 minutes. No, nope, it's 10 o'clock.
No, we're done.
How fast can we go through this?
The first section here, administrative considerations, is a little easier in the sense that the recommendation is to follow generally all of the personal income tax administrative provisions.
Okay.
Penalties and.
Decided that.
Could we say, the committee was in favor of setting a grace period to suspend. Could we just say a 2 or 3 year grace period? I mean, just something that, that's my memory of the conversation. So I'm looking for more details if we.
Sure, I thought there wasn't a decision made.
Yeah, great.
Okay. Maybe we could get to renters because that's one of the big variables here.
Would you like me to skip over? So the withholding is probably the most technical section.
And basically, we just said we're going to follow the present system and you're going to withhold depending on where you live.
Yes.
And we'll let the committees deal with the accountants when they come in.
I think on
Yes.
page 18, you maybe, there's a January 1 to December 1.
Yes, so there
Is
was.
that 31?
I'm sorry?
Should it be January 1 to December 31?
Yes. Yes.
Good catch.
Typo. Add a 3.
Tax-free 30 days.
Like Louisiana.
Sales
here.
tax holiday. Okay. Renters, what are we doing with renters? Because that was a big
Issue and is one of the legislative charges of the committee. So the committee's recommendation is that the current renter credit or renter program, which functions more as a subsidy, is maintained. So there is a note here because I did want to make sure it was clear. This would be a new actual tax credit, not a renter sort of subsidy program. The committee's recommendation is to have a non-refundable credit for renters against the education tax liability that they owe. And it would be structured as a percentage of gross rent paid. The committee had looked at different definitions in the past. There's allocable rent for the former renter rebate. This would be gross rent. You had discussed just what the individual is paying to their landlord, so not trying to parse out utilities or other expenses. There wasn't a recommendation about the exact percentage that would be used. You had provided some ranges. We discussed the assumption that part of the rent being paid includes the non-homestead property tax, so that would be the reason for giving a credit against the education tax, because those renters would already be paying into the education fund. There is a note that this would be an expenditure, so there would be foregone revenue that would need to be made up elsewhere in the tax structure, and it would likely be on rates.
Could we add something about double taxation? Because that's in fact the principle of why we want to give money back.
In order to prevent double taxation, we are proposing.
I don't think it's technically double taxation, and I think even naming it sets us up to a liability that we might not be interested
You
in.
can say something like the committee recognized that renters contribute toward a landlord's property tax or something like that.
Or that renters are,
That is included in the second paragraph of rental.
Okay. So
Okay.
do that. Okay.
And again, I would love us to just create a starting point. I mean, part of the goal, and I don't mean to just hammer on this, but part of the goal would be to help staff. If this were to be discussed in earnest in a month, all of these things that we're punting on we have to have a starting point. And so I continue to favor, our assertion of, start here and see what you find kind of attitude. And we, the old program was at 21%. We had sort of discussed that was more complicated and had its ways of backing out other things out, as you said, utilities. And so to me, I would pick a starting point of like 15% and see, but I don't know. Again, I'm not saying this is what we think you should do, but.
I'm happy to put in a range. The committee discussed a range between 15 and 30% or something like that.
I favor just something. I mean, we truly think about it in a month from now, if this was being taken up.
Did we discuss a range?
I think it said 10 to maybe the 21. So just
Yeah.
clear though, the 21 is not the amount of the credit. Under the renter rebate, there was then a calculation of the individual's income that was a percentage of how much the rent was exceeding a percentage of their income. So it wasn't just a flat 21%.
But the 21 was the estimate of how much rent we thought ended up in the property.
Right.
Going into the property.
In Act 60, there was a definition of rent constituting property tax paid. So yes, that's correct.
It was 21%.
I think, yes, it was
Yeah.
been 21% since I did some research, since Act 60.
Okay.
So yes, I'm fine with the range. Again,
Okay.
just
But
just something.
just so that there's something to hang your hat on. Because with the rapid increase in rents, without the same rapid increase in property tax, that ratio may well be changing or
What if
has
it's
changed.
Oh, no, I don't think, okay. I was.
Okay.
I thought, but.
I can include a example range.
I mean, at some point, like we went through this with last year's income and this year's tax bill, and just swallowing some difference makes it functional. So we have to pick a number, and you can't get into whether or not your heat's included or your water's included or not included. Just an average median, or, yeah, and it will follow. We think, in our best judgment, we think it will fall within this range. Okay.
There is a quick paragraph about potential situations that might need to be considered in more detail regarding renter credits. And there is a note on, for example, individuals who structure their property ownership as a separate entity, where this could potentially change behavior, but it's not.
Okay.
Just something to flag for further consideration. The non-homestead property tax and the education fund and the repeal of the municipal property tax municipalities, and then transition. Those are the remaining sections. I don't know if you want me to zero in on them or try and high level. We've already talked briefly about non-homestead property tax. It wouldn't be changed except for the base. So the homestead and 2 acres would be exempt, but there would be this new expansion of the non-homestead property tax base so that over 2 acres would be subject to the property tax.
Okay.
I'm sorry to ask this question because it's sort of going backwards and we're pressed for time, but it occurred to me in the renter thing, we've talked about this. Well, somebody sells to their LLC, they've got high income, they sell their house to their LLC, then they show up as a renter. In order to really get out of there, unless it just occurred to me, and I want to see if this is true. If you've got a really high income, and then the way we're structuring this, you've got to show that you're paying an enormous amount of rent, right? In order to have that back out and really not give you your actual liability based on your high income. At that point, the rent then shows up as your income, right? So I, as I was reading this, I thought, oh, there's actually, I mean, maybe some accountants will tell you some way to get out of that, but it strikes me that it's a little safer than I initially thought from this game. Am I kind of understanding that right?
Yes, because you're looking at 2 different tax types, but I think it depends on the scenario and how it's structured. But yes, the rent would be flowing into the LLC, and then that, that's
Sure.
pass through, so it would show up on their personal income tax. The LLC would be paying the non-homestead property tax.
Right, so we're sort of taking care of the ed fund there, but then your ability to cloak your income in this way so that you don't have an income education liability, I think it's a little harder than I had initially understood, I guess.
Unless we have a cap, if they're high income enough that they.
Well, the cap, that's true, that's a great point. Without the cap, sort of protecting the system.
Well, and that income that goes to the LLC, not only do you have to pay that regular income tax is much higher than
Yeah.
the education.
Which is just to say, it may not be really advantageous at all.
Okay.
Okay.
But still worth flagging, yeah.
Yeah, definitely worth flagging,
Yeah.
but I think it's important. I have approached this as like, oh, this is actually like a big loophole that we're gonna have to wrestle with, and maybe it's a little smaller.
I don't think it's.
Yeah, I think any committee that takes this up is going to have a CPA come in and
Yeah.
talk to them about
Yes.
potential.
Flag, this should be looked at in more detail. We do
Okay,
not
sorry, I
have time
just
to run
my
through
curiosity.
Okay,
scenarios.
so municipal circuit breaker,
Also there is the recommendation to retain the same structure for the education fund, the education payments and cash flow to school districts.
Yep.
That would not be changed. There is a note in here, because this is the education fund section, that the stabilization reserve would need to be, or that the committee recommends increasing the stabilization reserve. Again, there's this language due to the possible decrease in stability, moving to an income tax and away from property tax base. Anything else you wanted to add?
Or I guess the one thing that I would add is on the top of 20 are some of those considerations for policymakers regarding the stabilization reserve. And if you recall, towards the end of last meeting, as the conversation was developing regarding the stabilization reserve, we couldn't conduct any modeling about thinking about the size of the stabilization reserve without a bit more policy decisions being made. So some of those, it's not an exhaustive list, but some of those questions have been outlined here.
Okay.
Okay, so moving on to the next section, so we can breeze through these. The recommendation from the committee is to repeal the homestead property tax and the associated credit. Not going to go into any great detail there. That's not a big surprise. Municipalities, they are addressed in the report in terms of maintaining the same property tax structure for administering the non-homestead property tax, which would be retained, and maintaining the payments that go to that go from the state to municipalities for administering the state property tax. And there's a list here of what those are. Can work on some of that language to make sure it's clear what is being
The
listed.
state will be administering the new income tax.
Correct. Yes, and that has been added into the education section.
Okay.
And I did note that because the property tax credit would be repealed, there is one payment in particular that would no longer go to municipalities. In terms of the circuit breaker, the recommendation from so this is for 40 individuals who are homeowners with $47,000 of household income or less. Given that the property tax credit is repealed, that sort of leaves open this question of how would individuals get a credit against their municipal property taxes? Would that be retained or not? And the recommendation is to provide a non-refundable credit against municipal property taxes for homeowners using that threshold. The credit would continue to be funded by the general fund as it is now, and that the credit would use the definition used for the renter credit currently in determining that $47,000 of income, because the household income definition would be repealed. And that was sort of at the end of your meeting, so if this sounds.
I remember that differently, where we just maintained the household income declaration but it was just for this subset of people as opposed to the legions of people that use it now. So I'm happy to consider that, but.
For which people?
Well, for the circuit breaker, so that's folks that homeowners who as I understand it's for households with a household income declaration of 47 or less, right?
Current law, yes.
And so I thought our discussion was, yes, just keep it same form, and that's who would be using it still. It's a much smaller subset of people than we.
The notes that I had from the last meeting were that you were considering that and then concerned about the complexity of that household income definition, because that definition drives a lot of the challenges in administering the property tax credit, and that there was a decision made to move, and again, this was very much at the end.
Okay, all right.
That's what I thought.
To a simpler
Okay.
filing. It's like a 1 or 2 line form for the renter credit.
On the tax form.
So it would be on the income tax form, the individual would fill out these 1 or 2 lines, and it's a definition that's used for the renter credit. It looks at US HUD definitions of income.
And how do we deal with?
I'm sorry,
I'm sorry.
that's separate.
How do we deal with the household income number then in that scenario?
So that would be repealed, but you wouldn't be looking at the household necessarily. You would be looking at the filer.
So now a household with a $94,000 income could potentially, if they're filing separately.
What I had in my notes is it would still be set at the 47,000. You'd just be you'd be determining which income hits that 47 by using the renter credit.
So for most people, married filing jointly, you're going to get it. The outlier might be grandma who's got a nice stock portfolio, who's living with you. We're not going to pick up her credit unless the tax department's computer can match addresses, which we didn't get into. But since day one, that household income credit has been a sticking point and for people with lower incomes who probably can't hire accountants, I'm sure adding and subtracting this and that from your federal is daunting.
My memory of our previous conversation that matches your memory, Senator Pearson, that we did talk about just having a smaller pool of people using that whole household income form, but I'm happy to do it this way. I do think it simplifies things.
As long as it captures, as long as it doesn't suddenly swell the pool of people that would become eligible, I'm all for making it simpler.
Okay.
Your concern is that if you could have a household of 3 people all earning $45,000
Yeah.
a year and everybody gets.
Then the general fund takes a big hit and it's not our intention at all. So
I assumed that only one could claim the credit for that span number or something, for that house site.
Yes, it's just currently eligible because the whole household as a whole has, $100,000 in income. They wouldn't be able to claim the credit. Whereas this is now looking at.
Claim the credit. That's what I'm saying.
But even if one can.
Yeah.
it's still not.
Makes it bigger.
it's not what we're doing today.
Would you like me to change the definition and retain household and then just, put maybe this is, because again, this was, I think in the last 3 minutes of your discussion, did not get into a lot of detail. So I could change the recommendation to maintain household income, but consider with further deliberation, looking at the renter credit.
Simplify it. That might be.
Something along those lines.
He was trying to figure out how to peg it to the credit.
Okay.
Yeah. I mean, I don't feel that strongly, but I think we're articulating a principle.
Yeah, let's kick the can down the street. Send it to the committee who has the member who knows every way you could game a system. Work it out. Okay, I'm watching the clock here, so we've got transition and other impacts to go through, and then we have to decide what our conclusion is.
I think we could do that.
This afternoon. Okay, so we're on to transition.
The committee's recommendation is to implement the new education tax and all of the associated changes to replacing the homestead property tax and the credit at least 1 year after the passage of the legislation. And this will allow for setting up new administrative structures for the Department of Taxes to implement this new education income tax, as well as on the municipal level, because homestead property would no longer be on the grand list, would no longer be subject to tax, as well as educating taxpayers so that they can comply with the changes. There is a note here about any changes to the stabilization reserve could be made within that year or during deliberations. That would allow for time to build up any reserves, any additional reserves, pre-funding the stabilization reserve. There is also a recommendation here that setting an effective date for this structure should take into account the people waiting changes, which
Okay, that's what I was.
start in 2025, the fiscal year 25.
Okay.
In July 2024. And then there's again a note here about a grace period. I could add 2 to 3 years if you'd like, or just leave it open for taxpayers complying with the new tax structure.
I think I'm gonna let us ponder for a while so we can get to our witnesses who have been kind of cooling their heels. Because from now on, it's all our time, and so we decide how long we're gonna be here today. And Julia, you've got some modeling clarifications and follow-up to do after this. All right, so I'm gonna move us along to our always patient witnesses, and the first one is Stephanie Yu. Stephanie, you're here, I think, behind masks.
Since you're so far away, we wonder if you would come to.
Come on up.
We're not sure what's going on with the table.
Okay,
It anticipates a much larger committee, I think.
okay, it must have been a bigger group. So, make sure you can hear me. So good morning, I'm Stephanie Yu, the Deputy Director of Public Assets Institute. You've seen me a few times. So we were also submitting a written piece that has there's a couple of typos. You might want to note, I know you all went through this in detail, and then just sort of a couple of technical questions. But we really just wanted to kind of bring up one main issue today. And then there's a couple of technical pieces in the written pieces we will submit to SORSHA shortly here. But I think there's a lot, you all did a lot of work. And from our perspective, I think three major things are advanced in this report. The first is like resolving a lot of these technical questions about how to move to an income-based school tax. The second is preserving that critical link between the tax rates and the democratic education spending decisions at the local level. And then the third is this piece that you were just talking about, which is giving renters a direct stake in the education funding system while acknowledging their indirect contribution to school taxes. To keep a democracy competitive and thriving, students must be afforded equal access to all that our educational system has to offer. That is from page 14 of the Brigham decision. It might be familiar to some of you, all of you. And I think it says a lot about the importance of education. It's acknowledging that our public education system is really about more than the kids or the parents in the system at any given time. It's really the foundation of our democracy. For our democracy to thrive, we need educated residents, and for that, we need a robust public education system. But it also sort of goes the other direction, I think, which is it says something about the importance of democracy. This expectation that if we're educating our kids, they'll engage in our democracy, they'll participate in our public decision-making, and they'll make better decisions because of that education, which will lead to our democracy thriving. So that relationship between the direct vote on the school budget and the importance of public education is really key. Public education is a collective good. That's why we have this direct democracy vote. And so it's important that when we go into that when we go to vote on school budgets, that voters have as much information as they could possibly have. So the Tax Structure Commission found two things to be true about our education funding system. It's complex and it's equitable. And so we talked, like, in our mind, the goal should be that we're reducing complexity while retaining what makes it equitable, or if possible, advancing equity, which I think you've done with this structure. But you've also identified a lot of the hard trade-offs here, which are some of the things that might make it more equitable, might not reduce complexity, or in fact increase it. Going to the single system rather than the current hybrid system that's based both on property and income is a lot simpler, but making it progressive adds complexity. The improvements in equity might well be worth that complexity, but again, we sort of come back to this question of what is the voter seeing on town meeting day? What is their understanding of what's happening on town meeting day? And so that decision should be as clear as we can possibly make it. Because true democratic engagement depends on voters making informed decisions. So if we can provide more information to them ahead of that vote, that from our perspective, that's the goal. So again, you'll see a memo from us, and I'm happy to kind of go through the main point, that the main suggestion that we're making is that you set the rates or the yield in January. That was the original purpose of the December 1st letter. I know we've talked about this in different contexts before, maybe in some of your committees. But that was the original purpose, that the legislature could set the rates with that December 1st letter. They could set the rates or the yield early so that school boards and voters had that information when they're working on the budgets. And it did work that way briefly. But reinstituting that practice, I think, clarifies the connection for voters and reassures them what they're signing up for on town meeting day. Again, I think it's the trade-off. You do lose something in the precision of the revenue estimates, but the clarity for voters, I think, is worth that, given the many factors influencing revenue, which you talked about. And also, I think it sort of starts to generate this rebuilding of trust that voters have in the system, that they know that what they see is what they're going to get. And I think with the elimination of the general fund transfer a few years ago, there's no longer this sort of timing issue of other budget issues being dependent on what happens in the ed fund. So, I'm happy to sort of go quickly through the points we're making in the written and just to acknowledge the one mathematical thing that we found was on page 10. There was in that table that tells you how to calculate your taxes. I think the last line is supposed to be 225 and not 400,000. If you look in that last, we're at 90,000 people there. With that, I'm not sure if anybody caught that. On page 10, in that table, the above 90,000, in that calculation, where the third column, where it says 400,000.
Oh, okay. Yep.
So,
Third row.
yeah, the third row, third column, third row. Again, I think this is really just a matter of the trade-offs between the complexity and the equity pieces. We raised a couple of questions about whether the homestead declaration, and this is what you all were just talking about, so it sounds like you're on the way to resolving it. From our perspective, the question was, how do you know who's sort of a non-filer and a non-homestead owner, and how do you identify those people? So that sounds like you can resolve that. The other question we wanted to understand was whether the intention is that the rates change each year or the brackets change each year. As you identified, there's now sort of this multi-step process, which is you've got to figure out your rate based on your income. Then you're adjusting that rate based on your per pupil spending decision, which again, I think is important to the sort of preservation of that critical link. But will keeping those rates static raise the right amount of money, especially if it's based on prior year spending, which, can changes from year to year. So I think more modeling on that would be helpful, but we also just wanted to understand if the intention was that the rates could or were likely to change every year, or if the brackets are changing every year too. And then and maybe you all have gotten into this, but part of the question was, how are the brackets derived, and then what is the intended relationship between the bracket rates? With some of them, it's sort of like they're trying to get this amount of money from this group, or there's a proportional relationship somehow, and I don't know if that was part of the calculation, but that's something we wanted to clarify. And then we're also in the written testimony, we're also just providing some more detail. We did a little dive on in the census microdata on renters, and just have a little bit more information on renters and their income ranges, which, if that's helpful to you, or I know you have some information there, but we also look at dive into the microdata that gives you a little bit more information on that. So that was the main sort of point that we wanted to raise, is this setting the rates earlier. Would that provide more clarity to voters? We believe it would provide the maximum clarity to voters on town meeting day. And that would be worth it for any sort of, loss of precision in the revenue estimates. Again, knowing that those are still estimates and there's a lot of sort of moving parts in those pieces, and that your recommendation to increase the reserves could help sort of smooth that process over time.
Okay.
Do you have recommendations based on what we're recommending to go further on sort of that transparency, communication, simplicity thing? I mean, we agree that that's important. We talked about it endlessly, and I hear you saying it's important, but then what?
So one of the One of the pieces that we have in the written testimony too is, so at the beginning of Act 60, there were a lot of tax tables. You know, you got this tax table on at the time of your vote. So I think something that, again, a lot of it is and what the voter actually sees, which you don't have, which, you know, you can put requirements in place, but it's still sort of what gets focused on town meeting day is not totally under your control. But I think that those tax tables, so if you're going to have these brackets, you should be able to look on the tax table and say, okay, if I'm voting this for people spending it, I should be able to look that up on town meeting day. So just providing that information, I think at the time of the vote, or, you know, whenever the budget was presented, would go a long way toward people feeling like that was clear. You know, there's obviously, I mean, the system you've come up with, there's precedent for with personal income taxes. People don't necessarily know how all the marginal rates work, but they can look it up on a table and know what they're getting. So I think that goes a long way.
It sort of feels to me that the more straightforward comparison to my district versus the average, I mean, it is a formula. It's a formula that, you know, some people will bother to figure out. But it doesn't have that many variables, right? You'd have the local, how do we peg to average, the state's set rate, and my income. And then, although the effective rate, I gotta figure that out. But I wonder if that comparison to average district, my district versus average, I've not thought of that as being very explicit in today's universe, even though it is part of how we arrived there. And I'm curious what you think. You've thought about it more than I have.
Well, I mean, I think that was part of our question is we haven't been able to sort of do the mathematical analysis, but I think part of the concern is by basing it on the prior year average spending is that unless you change the rates from year to year, does that give you the revenue you need? And I don't feel like we can answer that question yet. I think that's one of the questions that would probably need to be answered. Is that the right? Because right now, the way it's calculated is really based on the tax base, right? And this is not on the tax base, it's based on spending. So it's a little different. So that'd be a question that we'd want to understand. I think that there's a lot of, different pieces of context that could be helpful to people. I think, like you say, how does my district compare to the state average? How has my district changed over time? Which is another question, so any of that information, I think, maximum information that could be provided. We publish town to town rates that give you some of that maps on our website, but I think, and it would be great if there was sort of a more public database of that stuff that could kind of, we can do great things with data visualization, pull up your chart for your town and see what it looks like.
Okay. Other questions? Okay, thank you. We now have Sue Siglowski, and there she is. Welcome, Sue, and the floor is yours.
Good morning. Sue Siglowski, Executive Director of the Vermont School Boards Association. I wanted to thank you for the invitation to provide testimony to the committee on its draft report this morning. And my testimony is relatively brief. We appreciate the significant amount of work that the committee put into the important issue of education funding and Vermont's education funding system, including the methods for generating the necessary revenues, is a subject that's of significant interest to local school board members and also to the VSBA. We have a resolution at the VSBA related to this topic, which states the General Assembly should examine alternative funding sources for our education system that are more equitable and sustainable, and I'll highlight those two words, equitable and sustainable, rather than continue a system that predominantly relies on the property tax for revenue. We appreciate the emphasis in the draft report on the 6 pillars of a high quality tax system and noted that the pillars of sustainability and fairness correspond to that language of equitable and sustainable in VSBA's resolution. We also appreciate that the draft report does not recommend specific action by the legislature, but rather provides recommendations for structuring an income-based education tax if such a tax were to be adopted. Within those recommendations is the removal of the homestead property tax and the corresponding income sensitized property tax credit as flexible levers, and the addition of education income taxes as flexible levers. From VSBA's standpoint, any such proposal for changes to the education funding system should be fully analyzed in connection with the updated and new pupil weights that will be implemented in fiscal year 2025 pursuant to Act 127 of 2022. And I know you make reference to that in the conclusion of your draft report. The updated and new weights were developed based on our current education funding system, and it would be important to understand how changes to the key levers in that system would impact the taxing capacity that's created by the updated and new weights. Finally, we appreciated the coverage in the draft report of recent legislative changes to the education fund expenses, such as universal school meals, PCBs, pupil weighting, teacher pensions, and other post-employment benefits, to name a few. And just wanted to highlight one more significant and growing education fund expense, which is healthcare benefits. In its annual Vermont education tax letter, the Vermont Department of Taxation projects an 8.5% increase in education spending for fiscal year 2024. The letter notes that this percentage increase represents a faster growth rate than has occurred in over a decade. While there are numerous factors causing this increase, the rapidly escalating costs of healthcare benefits for Vermont's school employees is a major ongoing factor driving this projection. VHI's Gold CDHP plan, which is a plan selected by 90% of eligible participants, has premiums that have grown at an average annual rate of 10.3% since the plan's inception in fiscal year 2018. And of course, we understand that the problem of rapidly escalating healthcare costs is not just a problem for school districts, and that all segments of Vermont's economy are significantly impacted by these increased costs. But we thought it was important to mention it. So this concludes my testimony, and I'd like to thank you again for the opportunity to testify.
Okay, any questions? Representative Kornheiser.
I guess I'm curious if you're able to get more specific on how you would like to see us sort of accounting for some of the things you mentioned into the future. So you mentioned that we should take into account people waiting, for instance, but what does that mean to you?
Basically, what we're concerned about is changing too many things all at the same time.
Great.
And
okay.
Yeah, so it's a matter of letting that the new and updated pupil weights go into effect, and being able to look at how changes to the funding system interact with that, and being able to phase in any kind of income-based approach.
Thank you. And I'm going to offer a clarification because I can't help myself. You listed people waiting as an added expense to the Ed Fund, and it is a significant change in how sort of taxes will be allocated, but it's not a new expense technically. Even though it certainly could be in the future.
Yes.
Yes.
We'll see.
Yes. Okay.
Yeah, I believe I took that list from your report.
Okay.
I'd have to look at which
We'll
page.
double check.
It is not a big deal. I just couldn't help myself because I'm a little obsessive about it.
Okay, any other questions? Not seeing any. Thank you.
Thank you.
Okay. And our final witness is Karen Horn.
Morning.
Good morning.
So I'm sitting here.
Wherever you would like to sit.
You're welcome to sit at the end of the table if you don't want us to hear you.
Okay.
It's a big room and it is hard to hear.
Yeah, it's the same problem in our town office right now, actually. So thank you very much for the opportunity to testify. And also thank you for the tremendous amount of work that you all have done and your staff has done on this issue. We support legislation to reform the tax system this is in our municipal policy, to ensure sustainability, affordability, equity, and balance. We support developing a transparent education finance system that reduces the education homestead property tax and more closely links voters' actions in approving budgets to the taxes they pay to fund their school districts. And I would note that Senator Cummings, you made a comment a little bit earlier about the sort of belief that people have that you can pass your school budget and it's not going to affect you, other people are going to pay for it. And that's a real problem from our perspective that we need to try to resolve. We have supported moving the homestead education tax to an income tax for several years. We do believe the initiative would reduce the burden on Vermont property taxpayers overall. It would incorporate more uniformity in the net education tax paid as a percent of income. And not incidentally, because I know that you all think about this, it would provide some opportunity for municipal voters to make long delayed investments in vital municipal services and infrastructure. We do thank you for your efforts to develop a path forward that would achieve the result in a timely and minimally disruptive manner should the legislature decide to proceed. We understand there's so many questions that need to be answered, and the transition to a new income-based system would need to be very carefully phased in. As Sue mentioned, particularly if it was concurrent with the new pupil weighting system. I think we will need to know which changes are affecting what. And so if you were doing both those things concurrently, that would be much more complicated. We do believe it's absolutely imperative that the legislature address the endless increase in education costs. And in fact, that it's every legislative committee's responsibility to take on that work, because virtually every committee's work affects education in some respect. You can think about the Healthcare Committee, the Natural Resources Committee and PCBs, the Institutions Committee with the capital budgeting and school capital projects coming down the pike, Human Services Committee, they all affect what goes into your education school budget. The fundamental problem with the education fund right now is explained in the draft report overview and background section, and I would just quote for you. Unlike most funding structures, Vermont's education expenditures are not a function of how much money is raised for education. Instead, the converse is true. Property tax rates to fund education are a function of education expenditures. So we've kind of stood it on the education fund on its head relative to other kinds of ways that you build budgets. And I do want to note that while property tax rates in the education fund have fluctuated over time, property tax dollars that are contributed to the education fund increase every year.
Not last year.
Pardon?
Not last year.
Well, I went, so Representative Beck, I went and looked at all the, like back to 2015, and I thought they did.
Not last year. They went down by.
Last year may not have made the charts.
I'm going to ask you about that afterwards. I just want to note that in no less than 8 places in the draft report, the mantra is repeated that each district's education spending is determined at the local level, where school boards set budgets that must be approved by the voters. We believe it's somewhat disingenuous to repeat that school budgets are determined by school boards and local voters while leaving left unsaid that virtually every year the legislature also establishes new mandates and requirements for school performance, facilities, curriculum, services, and administration that school boards have to ensure are incorporated in the budgets that are presented to local voters. And I spent 8 years on the school board. At that time, I was pretty familiar with Title 16, but you can go back and just sort of skim Title 16 and see that many of those requirements that have been embedded in the statutes over time. We do have a few preliminary questions regarding the draft report, and it may be that I'm just not understanding things correctly, particularly with the first question. We're wondering what are the assumptions that lead to the recommendation to both maintain a current renter credit in current form and create a non-refundable credit for renters against the education tax? It's not clear to me why you would have those two systems. And I think that if you're looking at it from the point of view of the public, people who are reading this, you might get that question from a number of people. Why are there these two proposals? Currently, the education property tax is the flexible lever to accommodate fluctuations in the education fund. I hadn't actually heard that term before. As we explain it, the education property tax is the backstop when other revenues fail to meet education fund obligations. The property tax holds the bag, so to speak. If, as the draft report suggests, the non-resident property tax becomes the flexible lever, would only non-resident property taxpayers be the one on the hook for increases when other revenues are insufficient to meet obligations? That would be a significant burden on those taxpayers, but there are other places in the draft report that indicate that maybe all the contributing education revenues are flexible levers. So there's some confusion there that I think needs to be cleared up. The report recommends allocating all education tax revenues to the education fund. That came as sort of a surprise to me. Why would that not happen all the time, every time, regardless? That all the monies raised for education go to the education fund. It further recommends using education tax rates, as I mentioned just a moment ago, as flexible levers. So would that include the homestead, non-resident, sales and use, all the other revenues that go into the education fund? And then the committee recommends maintaining municipal involvement in the state property tax system. We're a little concerned about how that would work, especially for properties that would need to pay a homestead income tax and a non-resident property tax. How do the towns and the Department of Taxes determine what the correct amounts were that were paid to each? How does somebody figure out what their obligation is overall and who gets what? It does seem to us that education taxes should all be paid to the same entity. We do have one additional recommendation that you haven't put in your report, and maybe it's sort of ancillary to the report, but we do hope the legislature will consider moving the system for reappraising properties from the current unpredictable and unmanageable system based on falling below 85% or going above 115% of the common level of appraisal. And we could move it to something that is on a more predictable schedule. The tax department could establish a time frame whereby every 7 or so years a town would need to reappraise, and everybody would know what that schedule is. Towns would be grouped according to geographic area, so it would be easier to join together to hire appraisal firms. And I just did want to note that a version of a reappraisal schedule is used in many other states and provides predictability for the municipality, the appraisal firm, the tax department, and actually the property owners. we've talked to Property Valuation and Review about this concept. I don't know if you've heard from them recently, but there's about 100 towns that need to reappraise, given the volatility in the property values right now. On an ordinary year, about 16 town reappraisals are done. And right now, towns who are not able to find anyone to do the work at all are looking at maybe as far out as 7 years before they can secure a reappraisal. We've heard from some of the reappraisal firms that part of the issue is the unpredictability in Vermont's system. And if you were on a schedule, you knew that, in 2028, you were going to have to do a reappraisal, and you could join with your 6 neighbors to do that, to secure the firm, that might be a far better resolution to that particular issue. So I want to thank you again. The conversation earlier raised a whole bunch of other issues that I'm not organized enough to talk about right now. But you have done a huge amount of work, and we really are grateful that you're moving ahead in the conversation.
I appreciate you naming the spots of confusion, because I think us reading it ourselves is sometimes hard to know what is not immediately transparent to the outside world. So I appreciate you adding those. So education expenses have been going up because the world is an increasingly complex place with complex needs. And I think that's true for municipal needs as well, right?
Everything.
Yes, municipal expenses are going up. And I very much appreciate it that communities see the move to an education income tax as an opportunity to raise more revenue on the property tax for municipalities. I think that makes a lot of sense. And I'm concerned that while our education property tax in current law has a lot of progressivity built into it, our municipal property tax does not. And so if we see municipalities getting increased revenue from the municipal property tax, that might create an overall regressivity in our taxes throughout the state for the average taxpayer. And so I'm just curious if that's something that you all have thought about ways we could make our municipal property tax system more progressive if we are going to see an increased revenue going to that source.
Well, we believe that you would see increased municipal revenues. The voters are the ones that actually adopt the budgets, and on the municipal side, it's very direct. So here's the budget, here's what it's going to generate for a tax rate, and here's what you're going to need to pay. I haven't thought about this really a great deal, but there is a whole section around exemptions to the property tax and limitations to what you need to pay on the property tax. And I suppose, I'm not really offering this right now, but I suppose you could look at those kinds of sections and put together a more complete expenditures report and see what might work. The other piece, of course, is that you could grant municipalities some authority to put some of that progressivity into their municipal tax rates, and they don't have that authority now.
I would love, as we move forward in these conversations, for VLCT to keep on really being creative and thinking about solving this problem, because I think it's a big part of future conversations around revenue for municipalities, and I think it's a concern.
It is.
I know that there's the direct democracy, I think, does help in some ways, but if I use sort of my favorite example, wealthy town of Woodstock, I think the majority of folks in Woodstock might feel comfortable raising their property tax rates, but there are people in Woodstock who live there who cannot necessarily afford that, and who would still be subject to that rate. And so that's just something that I've been.
Right.
It's just one of my background concerns about this move. And I appreciate that municipalities have increased expenses like everywhere else and need to raise that revenue. So just in the future, as we're having these conversations, I'd love to keep on trying to.
Yeah, if I could, that just does make me think that we we do have situations in towns, obviously, in every town, where people end up being delinquent on their taxes because of inability to pay. And most towns, the delinquent taxpayer, the collector of delinquent taxes, as Beth Hill always used to remind me, she's not the delinquent tax. We'll try to work with people and put them on a schedule and make it achievable for them to reduce their property tax debt. There is also provision in the law that allows towns to reduce the penalties for delinquencies. So those are two other sort of.
Sure, those are all worst case scenarios though, and some towns don't do that. So I'm thinking like if we are building a tax system or shifting a tax system, how could we make something that would really work for people rather than just have sort of like escape valves for it? But that's another, it's a conversation, we don't have to talk about it now. I just want to like put that in the hopper for the session.
But it is issue. I live in one of those towns.
Well, yeah, and that's the other thing, the more services, the higher your taxes. And so,
Or
Barry,
I mean, there's all kinds of things
services
there.
that the towns have, but also, you know, parks and recreations facilities and things that unless you make less than $47,000 a year, you're going to pay for. And given our housing crisis, there's no alternative for you
right,
to move, and
yeah.
so you're completely broke.
I'll just mention that another thing that we've discussed over the years is like all the people from Moortown, say, drive into Montpelier and use all the services. And so
There's a whole option too.
We've been talking about that for years.
you know, because those county seats essentially are providing those services, is there an obligation from outlying communities?
Well, now the state employees aren't coming in and our downtown is feeling the crunch. So it's a constant balance, I think, between, and every town has an inflow and an outflow, but it's there. And at some point, we have never talked about tax burden. And if we lower the property tax burden at the state level and increase the income tax burden, but the towns then increase the property tax burden, the total tax burden on the citizens, not to mention all the other services that people would like from the state. This year we're looking at paid family leave and childcare. We don't have a tax capacity study, but there is, and this country is very different than other countries in our attitude towards taxes. And so we're always in that juggling position.
We definitely understand that. And we would also point out that some of our towns are in absolute crisis around like law enforcement and emergency medical services. We don't have the money to pay. We can't find the people. Everything's connected, right? And but the issues around our ability to actually deliver services are of huge concern to us now.
And I want to make sure that acknowledge what you said about reappraisals being a disaster right now. And I think everyone on this committee knows that, agrees on it, and it's totally outside of the scope of what we're working on right now. So I appreciate you saying it. I want to acknowledge that you said it, and there probably won't be anything about it in the report.
No.
You say the reappraisal systems.
But that doesn't mean it
We
won't
reached
come up the
consensus.
same.
You just declared we had reached consensus.
Does Vermont statute allow for rolling reappraisal?
There are a few towns that do it.
Yeah.
My understanding is within their community. So I believe Hartford does something about reappraisal. That's the one example that comes to mind.
I lived out of state where they did that and it was wonderful.
Yeah.
Just,
I don't think we prohibit people from doing it more often than we force them to. I think it's just people don't do it until
Don't
they're
do it,
forced to.
But I mean, right now you can't find anybody to do anything, so, reappraisal laws.
I want to call the committee's attention to the fact that both Jeff Francis and Jeff Fannin submitted written testimony because they couldn't come, and that will also be posted on our committee page. Is posted on our
We've
committee.
all been copied with that.
Okay.
Francis,
yeah, I didn't see Fannin either.
Yeah, which one of them I saw come in?
that was Francis. We didn't have one from
Fannin.
Fannin.
We haven't received.
Fannin.
got it, yeah.
We just got it. Okay. It will be forwarded to you.
It was at 10
Hasn't
o'clock this morning.
momentarily. Okay. As soon as we have it, you'll get it. All right, we are back to Julia.
I'll be back in a second.
Hello again, Julia Richter, JFO, for the record. I have a presentation that's posted on the committee's webpage. I believe there's also printed copies on the desk here. And this is regarding follow-up modeling of education income tax rates. So diving right into the first slide, general notes. These rates and brackets were modeled based on committee guidance from December 2nd meeting, which was your last meeting. And we've modeled two potential rates and brackets that I will be presenting shortly. So just to sort of refresh your memory, I know it was a few weeks ago that the last committee meeting happened. The first request was for us to model potential rates and brackets to raise approximately 600 million. And this 600 million was based on the 474 million that was used in the initial modeling for the entire net homestead tax, what we were talking about this morning. And then an additional 126 million to be raised. And this was representing the funds from the filers who couldn't be linked to a homestead declaration. So that 126 million was provided by Jake Feldman of the tax department in his testimony at the December 2nd meeting. So because we couldn't parse out in the model, who was renters, who was attached to a homestead in the Chambridge tax model, the committee asked for us to raise just the whole 126 million that Jake or the tax department had estimated. And then the other potential rate and bracket structure that was requested was to take it one step further. And because the committee had moved towards a recommendation to reclassify that additional homestead property that's beyond the house site and 2 acres as non-homestead, to take those savings or revenues, so to speak, of not losing that tax base. So we estimate that would be 40 million in savings for that reclassification. And I do have a slide further down talking a little bit more about that estimate, if that's helpful, but just so you have a sense of what we're going to go through and do here. The rate modeling was conducted by our analyst, Patrick Titterton, using the Chambridge tax model, and using the same assumptions, the same data set, everything the same as the previous rate and bracket structure that we've looked at in this committee. So I'm on slide 3 here. This is just a reminder of what we had looked at back on November 10th, the potential base EIT brackets. These were the brackets that were set up sort of a first pass in terms of a progressive rate structure, tried to base it on brackets that seemed to align with what the committee had mentioned to raise the dollars. So those are the modeling results we had looked at. And then moving to slide 4 shows the modeling results for that 600 million via the education income tax. So this is what I spoke about, where where we are replacing the entire net homestead tax, so the 472, 474, and then the 126 million, that number from Jake Feldman. And you can see, of course, that the rates are substantially higher because more money needs to be raised.
Can I just help me understand? We need to raise more money, but then we're assuming that the 40 million comes from reclassifying. So doesn't that mean that in the end, I guess
Yeah.
these seem, well,
So-
I'm missing something. Raise.
So I think that your question is,
Another table.
once again, getting at where this presentation is going.
Okay,
So it's
sorry,
sort of
sorry.
2 steps.
Okay.
So instead of, I think it's helpful to see
I'll sit on
each
it.
step, and then you can see how different steps impact the rates. So this is the first step where we're saying, okay, let's add in that 126 million and see what happens
I see. Yep.
when we're replacing the entire net homestead and we're raising the additional 126. And right now, we're not doing anything about reclassification.
I need a little base explanation on the 126.
Yeah, so that, if you will recall, in the previous committee meeting, oh, you weren't here.
Right.
Okay, so the previous meeting, Jake Feldman from the Department of Taxes came in and he performed an analysis that was using his additional data that he has that we at JFO don't have access to. And basically he was trying to parse out how much money was being raised by filers who he couldn't connect to any homestead. So there was
And that was previously
120.
not part of the 472, 474.
It was part of the 474. So the 474 is saying, okay, we're going to impose this education income tax on all folks earning income in Vermont. And then we at JFO did a preliminary estimate of trying to figure out, of that 474, how much of that was being raised by renters and folks who currently are not paying a homestead property tax. It was quite close to the tax department's estimate, and the tax department said they estimate 126 million would be raised by folks who would have a new tax liability with this education income tax.
Okay.
And so because we couldn't, because the way that our modeling is, our data set is set up and the modeling that we've done thus far, we can't figure out who each of those people are and what their incomes are. So the committee requested, okay, 126 million is being raised by people who we can't connect to homestead. So let's see what it would look like to raise that full 126 on top of the 474, which is the 600 million.
Yeah.
And if I'm also happy to sit down and
No, I understand.
more detail.
And just from a larger view, in our recommendations in the report, we're talking about dealing with renters in a different way so that we would still raise the 126 million from these non-homestead, people who are not tied to a homestead.
Give them a credit.
Yes, the challenge is any credit or exemption or anything is also an expenditure. So
Yep.
those dollars
Right.
need to be raised.
Yep.
So this was a way of trying to figure out,
Okay,
Like 100 million of it might go back.
Right.
Right? So suddenly we're got a hole.
We're 100 million short.
like right now, the homestead and non-homestead raise, in fact, more than they need to cover that property tax credit.
great. Thanks.
Yeah.
Just so I understand, these rates are marginal rates, right?
Correct.
Okay. And did we ever discuss just linking them to, by my quick look here, they're not linked to the way our regular income tax, the breakpoints, like our tiers in our just income tax are not at the same AGI breaks, correct?
I'm not sure. I will defer to someone who works in income tax.
They are not, but
Yeah, okay.
They're tiered towards where the funny stuff was happening in the old graph.
Yeah, so
Please rephrase myself.
The red circle.
So
Now, Greg.
it was a first pass at trying to figure out where the different cutoffs are that the General Assembly has considered in the past. So you see the 90,000 in there because that's one of the cutoffs in the current property tax credit. And this goes back to the conversation of including rates in the report. These brackets are just really our first pass at modeling. It's in no way a recommendation. It's really just as a starting point.
Illustrative purposes.
To get some numbers on the paper to look at, but it's not a recommendation.
We wanted to go to the income tax brackets that we have for the income tax, then we could model that, but that's a future decision.
Correct. It's a policy decision. How many brackets, which brackets, the slope of the curve, it's all policy decision.
Okay.
So this is really just meant to serve as a starting point. And then we put together a couple of graphs just for consistency. They're set up in the same way as the graphs that we've looked at in the past. If you can remember back to the November 10th meeting, we looked at a couple of different graphs. So here on slide 5, we have the estimated change in the income effective tax rate by AGI group from the education income tax. So if you recall the AGI groups that we've separated down here on the x-axis, these are those ventiles that we were looking at by household income. So we set up the graph that way just because that's breaking points the committee has looked at in the past. When we're looking at the change in the income effective tax rate, that's on top of their current income tax liability.
Okay.
But it's not compared to how much they're paying in property taxes.
Correct.
Right, okay.
Correct.
And that part, that's confusing.
Okay.
Okay, so right now, this is the line on number 5, is doing what we've tried to do. It's slightly graduated, no big curves. But the income tax rate goes up at a slightly steeper curve, right? So that would be another line on here. This would be added to the.
Correct. So this is really just looking at the impact. This is really just looking at what the curve of this new
tax is, not, but the overall.
No.
Yeah, because looking at this, some people within what is, I believe, our top bracket now, some would be paying a 3 and some would be paying a 3.15% additional, depending on where they fall in that top bracket.
Could be 2, depending on what their district does. I mean, yeah.
So this is really looking at the change in the effective tax rate.
Right.
Yes.
Okay.
And we didn't parse it over the change from the homestead property tax, which if you recall during the November 10th meeting, there was that challenge in terms of looking at the impacts on homestead. We could look at the impact on homestead owners and then the non-property owners and the difficulty in understanding that. So this was really just to show the curve of the change in effective tax rate. And then the next graph on slide 6 is showing the total tax rates by the different AGI groups. This was another one of the graphs that we looked at. You can see it has a pretty similar shape to what we saw or when we first looked at this. So this is really just to show you that the shape is remaining similar to what we were looking at November 10th. And then moving on, unless there's more questions, I'm now on slide 7. And this is getting into that second part of the analysis. So reclassifying the homestead property that's beyond the house site as 2 acres to non-homestead. So we estimated that this would increase the non-homestead property tax by approximately 40 million. And that would in turn reduce the funds that would need to be raised from the education income tax. We assumed 2021 grand list values and property tax rates. And I know the committee is well aware, but I'll say it to be on the record, that changes in any number of those variables will of course impact the estimate.
Okay. I'm quite certain we're going to have a proposal this year to separate out the residential non-primary residence from business property, if nothing else. We now have couple acres that's attached to a homestead. That couple acres we're going to tax at, I guess we have to leave that, what non-property tax, especially if it's not accessible, you know.
Certainly, that is definitely a policy question.
Yeah, we've got this thing hanging out there that's neither fish nor fowl.
Yes, and it will, I imagine, will receive a lot of analysis moving forward.
I guess we might get to do that.
The way that this 40 million estimate, the way that we did this was we looked at grand list values by town, and we looked at the house site and 2 acre value and the overall homestead value and the difference. And that was that extra or additional home site
acreage,
homestead, acre value of that acreage. And then we multiplied that by the town adjusted COA non-homestead rate. And that's what gave us the 40 million.
Okay.
So we assumed the 2021 non-homestead rate, the 2021 CLAs, the 2021 values. And that's how we came to the 40 million.
Okay.
And so this graph on page 9 is the one that's closest.
Page 9.
Sorry,
Whoa.
slide 9. Am I totally ahead?
No.
You're on the wrong page.
So we can certainly move forward.
Forward.
I guess I've moved forward on my own.
Are you on 5 or?
So I was on 7.
You were on, yes, I know where you.
Oh, okay. I was on 7.
Abbott and
I'm just
Costello are
looking-
here.
Sorry, I was just looking at the graph of what you were talking about on 7. I didn't jump that far ahead. I will let you get there.
No, that's great. I'm happy to move forward quickly. 8, those are the rates and brackets. They're the same brackets that we've been looking at this whole time.
Okay.
Now we're raising the 560 million. And the reason it's 560 is because we went from the 600 and then we added those new non-homestead revenues of 40 million, which gives us 560 million raise. So that's what we're seeing, the rates reflecting that on 8. And then on 9, you see a first pass at model it. You see the graph of that first pass of modeling the rates to raise 560.
So as we add to the income tax, we're going through and progressively estimating how much money is raised through non-property and then through the excess property, and we've got the renters or non-homestead owners. That is because we started with the money that was raised with the homestead property tax. And then we had to add in the money that we were raising that was being paid into the education system by people not attached to a homestead. So that's renters and second home owners. And we took that amount. And then we took the amount of land that was not attached, and we added in what we would have to pay with that, which is why we've gone up from 54 to 560. This is the total amount we are now presently raising, or closer to the total amount with property tax.
So that's a great nuance that you're bringing up here that I think is really important to be flushed out, that we're looking at these different, so far in this slide deck, we're looking at raising 3 different numbers. And that's an example of potentially 3 different amounts that would need to be raised based on policy decisions. So that 470, 475 number, that is solely replacing the net homestead property tax and assuming everyone with Vermont income is paying that education income tax. The 600 million is a very rough first pass at parsing or trying to get some ballpark with respect to some sort of credit or exemption for people who are not connected to a homestead. It's rough because they're still included in those people while we're raising that 126 million additional to account for them. Those people are still included in the modeling, in the model that we have built to calculate those rates. If that makes sense. So it's not, it's rough, but that's what that 600 is trying to get at. And then the 560 is then taking it one step further and then using that 40 million of reclassifying the additional homestead.
And so what I was going to ask about slide 9 is, it seems to me that this is the one that's closest to the policy recommendations in our report.
I would say yes. So in terms of the modeling that we've conducted, this is the closest, and it is a first pass at what some rates and brackets could look like.
Julie, can you explain to me why, when we go from 600 million to 560 million, would that, be on the home site, do the percentages change, even though we're raising less money, like the high ends percentages go up and the low ends go down? Is that just because?
So that's a great detail. Our understanding from the committee's guidance was for a progressive, the committee was interested in seeing a progressive curve. So by decreasing the rates at the lowest end, that has the largest base. So that's decreasing the rates for the most number of people or taxpayers. So that's why you're seeing, and then increasing the rates at the higher end raise, of course, more revenue and impact fewer people. So it really is, I know I sound like a broken record, but it is a policy decision.
Right, but so when you look at those two, either that line graph or the chart tables, are those created just by raising the amount of money, or did you make other decisions to adjust the rates? Does that make sense?
Could you rephrase?
So like on graph 8, which has the percent, the EIT rates from 1.85 to 330, raising 560 million. And if you go back to graph 4, which is 2% to 3.15 to raise 600 million. So did you do anything else to change those rates, or was it just, I don't understand why those rates are changing by the fact that we're raising $40 million less.
So those rates changed because the only decision that we made was trying to figure out what rates would raise the dollars that needed to be raised. And so because these are marginal rates, we see that a change by decreasing the rate in the lowest bracket, that will impact the most number of people.
You made the adjustments to raise that amount. You could adjust different ones, different ways to raise them.
Certainly. And that goes back to my hesitancy of including these in the report, is because it really is just a first mathematical calculation of, from our perspective, how can we raise this number of dollars? What are the rates? And then we've raised that number of dollars. It's progressive. Okay, that's what we're going to present to the committee. And you all can decide where to go from there.
Okay.
I do notice, though, that even though the rate changes are what Senator Perchlik described, the effective tax rate between the 600 and the 560 is lower for across the board.
Exactly.
Because it's raising less money.
Right.
And that gets back to, of course, the difference in marginal rates and then the effective tax rate.
Okay.
Okay.
I don't think I've ever seen a slide deck with an appendix in it before. So I did that. Like real next.
I think I was like so into drafting of the report that I was like, we got to throw in appendix. Yeah. But that is, if you do want to go back and look at those previous estimates, the 126, for example, is there. Any other questions?
I think now is when we decide which tables and how to frame by 12.
Yeah.
Yeah, sure, easy.
That's the question, is
Easy.
how to frame them
Done.
without explanation.
No, plenty of explanations, because we need caveats.
So I think that there's a lot of value in including figure 3 on slide.
Table 3.
Table 9.
Figure 3 is labeled figure 3.
Oh, you're talking about the other one. Yes.
On slide 9, because it's the one closest to our policy recommendations. But I think if we're doing that, we should also include the figure 1 as sort of an example of if we'd made, it's sort of the example of like, if no policy decisions are made, basically, this is what it looks like. So that readers could understand the impact of policy decisions on rates.
Okay, so that's, you're looking at graph on page 3.
Yeah. Figure 1.
Yeah, 3
Page 5.
on the slide deck, 5.
Page 5.
Figure 1, not.
Figure 1,
Page 5.
page 5,
Yeah.
I think is the one if no policy decisions are made. So I think it's
I found the
helpful to-
figure 1,
I think
okay.
it's helpful to provide both of them for lessons' sake, I guess.
Am I right that we're still going to honor the request that we have a draft bill? Because I think that allows us to, I agree with including these. I think that makes sense. But it allows us in the report to just say, for the purposes of a draft bill, we've done X. And that way, I guess that suits my needs, but also I think maybe lets us say there's tons more work to do.
So include the tables, but one of the caveats around the tables is we're including them because we know that
Because the charge made us come up with a draft.
I want to add a caveat in the draft bill that it might not be ready by the first day of the session.
Yeah.
We have to decide what should be in it before it can be drafted. Which,
And that it might be a draft bill that has lots of,
yeah, and you would.
that has a lot of decisions left
Add
to the
text
committee.
here.
Well, of course.
Yes, 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 yes.
Short form bill.
Yes.
Well, I think maybe come up with the same questions we do.
Of course. And we're sort of, to me, we're pre-gaming the questions that helps staff
Yeah,
understand some of the, obvious work ahead. But anyway, I'm sorry. I agree with you that the two charts lets us, or the two figures lets us help people. It's effectively presenting a range.
Right.
And is the purpose here with those two line charts, line graphs, to sort of show the progressivity of what we're talking about?
I think it's showing the progressivity of what we're talking about, and then just like a vague range of reference points if someone is wondering like, what does this even look like? And I think it's really important, and this is not, I don't think me being fussy, I think it's important. The way estimated change is labeled, I think readers might think it's the estimated change from the property tax responsibility rather than the estimated change in income tax responsibility. And I definitely don't want people to be making that mistake in reading. And that's the top question that I'm getting from folks outside of this room is what will be the change from someone's current property tax responsibility?
We don't really know.
We don't know the answer to that, so I want to make,
Yeah.
so I want to be really clear that we're not answering that question since we can't.
We have the back to the chart with the red, now gray circles. We have seen these sort of superimposed before.
Once we add the renters, we can't superimpose anymore.
You could superimpose with a note.
It would be like real,
This doesn't include renters.
and we're not,
Well,
and we're not superimposing the policy recommendations. I mean, people can look back and see that graph, but there's no way to superimpose these graphs onto the, Julia, would you like to come explain?
Why we can't do that?
What do you mean we can't do something we wanted?
Julia Richter, Joint Fiscal Office. So the challenge in terms of superimposing these graphs is the first being renters are not included. And while we could include a note that renters aren't included, it would be very misleading because it would appear because more people are going to be paying this tax than people who currently have the tax are going to be seeing a decrease in tax liability.
Right.
And so if you recall back in November 10th, when we separated the graphs in terms of homestead, the homestead property owners and then the non-property owners, when we first looked at the homestead property owner charts, it seemed as though everyone, and it was the case, that all of those individuals or households would be receiving would have a lower tax liability. Then when you move on and you see that there's going to be an expansion of the people who are responsible for paying this tax, then in fact we realize that those preliminary superimposed graphs don't tell the whole story.
couldn't we label the graph like comparison for current homeowners? And that does get a huge majority of our ed fund contributors, isn't it?
I think it's different. I think like superimposing one base onto another base is just,
Yeah, it's really hard to do.
it just feels like, it's like when you have, like when you change the scale halfway through a graph, it just feels really,
Help me understand why we've looked at those superimposed in the past and now.
because it was before we included the renters in the modeling.
What if we said, for current homeowners, here's the comparison?
Because the base numbers change when we add in renters, isn't that?
Well, but the comparison is with the renters factored, but you know, your renter, you know that the chart doesn't apply to you because anyway, I don't care that much. I'm just sort of confused.
You're talking about taking this graph and kind of superimposing this chart. We don't have a line graph on this chart for the 474 million. The 474 million is without the renters.
No, this is where's our final one? this is what we think to be, like if we had to file a bill, this is the one, page 9, that's the chart, that's the table, the figure that we think exists for the universe, right? So that includes renters. But for the comparison, if you were to superimpose it and say, here's what the comparison is for current homeowners, the line still applies. It's just that it doesn't tell a renter very much because they're not a homeowner. But anyway, I don't care. It's confusing me why that would be such a problem.
Let me just ask, just pick on this graph a little bit, but do we really want to use the word change in there?
I've been picking on that same spot.
Have you?
Yeah, I don't think.
And I don't think it's not the change, it's not measuring change, it's just measuring the estimated income, effective income tax rate, right?
I think
The EIT.
that light was actually thrown by the word change in there as well.
Yeah, because depending on what you're paying for
I
property.
think somebody might read this and think this is the difference between current law and what we're.
It's the difference between the current income tax liability.
Okay, so
And-
change in income tax liability does
But
not
you see
factor
that-
in
You see
Property.
that if we're looking at slide 9, we're looking at the
Yeah, that's,
line graph on slide 9, and then we look at the rates on slide 8, we see that the EIT rate is 1.85%, but that we see that in fact, the estimated change in income tax liability is 1.78%. And that's bringing in exemptions, credits, and personal income tax.
so are
And
you, go ahead.
I think we've tried to be clear that this is not an addition to the income tax. This is a separate new tax called the education tax.
Impact.
right.
Impact.
So I think when we talk about, I think when we talk about change, it makes it seem like this is just a new thing added to the income tax rather than a
So
separate new tax.
the vertical axis that says change in income effective tax rate is actually just income effective tax rate.
Right.
Or education tax, effective education tax.
Yeah, it doesn't, there's no line in here that estimates what's going to happen to your property tax
Right.
rate because that's not connected to that's totally local, totally devoid of, well, no, if you're sensitized,
That's tricky too, isn't it?
yeah.
What if we just said, impact of income, education tax, and then, a note that said current homestead education tax will be $0. Like, so you don't try to represent it graphically, but you put that, it's a very central fact.
You can sit down
Getting a
and
2%
do,
increase in my income and a huge, decrease in my property tax.
yeah, you can sit down and say, okay, I've got $100,000 in income. This is my income tax bracket, plus I'm going to add this percentage. That's what I'm going to owe in income tax. And we can call it whatever we want, but it's an income tax increase. Then I can look at that number and I can look at my property tax bill or what I pay and decide if it's up or down for me, because every one of those is going to be different given property value, school spending. And we also have to remind them to take out municipal taxes because you are going to still pay that.
I have a concern, and I'm not a tax person, so you can all say you really don't need to be concerned about that, Peter. But since there is no policy recommendation or decision on a cap at the high end,
Right.
and I guess I don't know if that is something that is likely that's a likely addition to this that will happen in the creation of a bill. Is this a false number because it contains no cap? In other words, is it really representative of?
It's a real number if
Unless there's
the
a cap.
policy committees
Yeah.
don't put a cap on.
Yeah, right, and I guess I don't know enough about the policy implications of caps to know if it's a highly likely thing that a cap would be imposed or if it's a highly unlikely thing. And if it's highly unlikely, then this is
Make up
great.
with the Vermont legislature, I would go to unlikely.
Unlikely to have a cap.
But there, you get to the small percentage of people that pay 50% of the tax revenue. Very wealthy people tend to be older and may not have kids in school. They may make a good case for why there should be a cap. We haven't gotten into that total tax burden and are we competitive? Those are things that the committees are going to work out that'll affect the.
Are you asking because you want to make sure there's a caveat
I guess
in
it
the
needs to be a
chart?
caveat in the chart.
I think that makes sense. Okay.
Right. I think.
Because I don't have a sense of whether if we put a cap at $500,000 or $1 million,
It's an important caveat to have in there that there's no cap.
how much it would push that line
It
up.
does not include any cap.
It makes a big change. We saw that before.
Yeah.
We're going to have a whole lot of footnotes on this.
Can I ask Julia another question on this issue about whether we use the word change?
Yes.
The saying change is change from zero, right?
So I've actually, so because I didn't do the modeling, I've invited Patrick Titterton. He's on his way over, so he can maybe provide more helpful context in terms of the wording. I don't want to speak to what would or wouldn't be correct. I'm at my limit of knowledge and I don't want to misspeak.
What if we, instead of change, just called it new?
Right.
Well, that's my question.
New
Is
education.
that what it is?
Yes, that feels much more comfortable
Yeah.
to me.
Yeah.
I mean, it feels more accurate with what because we're creating a new tax, so it's the new rate.
Estimated new income effective tax rate. Not.
For education.
Which I'm
but
fine
new.
with if that's what it is.
So your new tax rate is going to be 2.62% at the top end. Plus
That's your base rate. Yeah.
change in estimated, no, we want to do, want to say additional, even though we know that's what people.
Just FYI, how people pay at 90.
Spreadsheet.
They're earning 90,000 today. They're paying about 2.6 when they're sensitized.
We're nitpicking.
Yeah. 90,000 today.
Did Julia give you
2.32.
context via text message?
No, sorry.
Arrive?
I'm a little cold right now.
Okay. So we're talking about, I've now lost my graph, but we're looking at the presentation and the use of the word change in effective tax rate. We're concerned that readers will experience that as a change from their property tax rate. And just want to make sure that we're clear on what you meant by change.
And one of the suggestions is just estimated new income effective tax rate, or maybe additional.
education
but
tax rate.
Education tax rate. Effective, yes.
So Pat Titterton, Joint Fiscal Office. I think that's a good way of phrasing it. So this modeling is not taking into account anything to do with your property taxes. It is built on the income tax model software that we use because it operates in we have all the data we need from there. But if you're comparing it on a baseline to baseline, this effective tax rate is representing the change. So if we ran it on baseline, it'd be 0. So the change that is being referenced here is kind of what you're talking about. It's their new effective rate.
Okay.
So if we called it the effective education tax rate, that would be accurate? Estimated effective tax rate.
I think that sounds good.
Great.
Yeah.
Thanks. Thanks for running here for that. Is there anything else you want to tell us?
That's it? Okay.
You can zoom
Anything else?
in. You can zoom next time. You don't have to run.
Thank you, Pat.
That's true.
It's good practice for the session.
Oh, yeah.
So I can certainly make that change.
Okay.
I just wanted to defer to the modeler.
Okay.
Any other questions for me?
Okay, so we're making that change in the wording. Is there anything else?
But the question is this, you're in the wording in the report, this isn't in the report. So we're changing slide deck or what are we adding to the report is the question, right?
Or are we? I think we've been at this for months. And I guess the question is, we've got the report. We can add, and maybe it is that last just graph with the changing wording, because once you put out there, it's going to be 2.65% without all the caveats, then that's what people focus on and say, well, I voted for my tax bill thinking it was going to be 2.65 and, additional, and it turned out it was 3.65 because I'm in a high spending town.
Should we also put the word in there, average?
Estimated average.
Yeah.
Yes,
Yeah.
thank you.
Yeah, okay. One question Karen Horn raised is, are those base rates going to change every year?
We have the ability to change them every
That's
year.
what I thought.
So that question was referring to, I believe, back to, I'm not sure which part of the report.
The high and low
The report
spending.
that talks about, using the different the adjustments
Yeah.
within the system. And one of those adjustments is adjusting the rates. So,
It's using that instead of the yield.
sorry?
Just using that instead of the yield is what.
Exactly. That was our understanding of what the committee had decided.
That's
We've included that.
my understanding.
And then going back to, if I may, including this chart. This chart is based off of the brackets and the rates that we're looking at on slide 8. So does the committee recommend that there's 6 brackets, that these are the 6 brackets and that these are the associated rates?
I think we could call them illustrative brackets rather than recommended brackets.
Okay.
And I would want to make sure that the committee also was interested in including that first graph and first set of brackets so people understand. I feel like then we're demonstrating not just illustrative brackets, but demonstrating what happens when a policy decision is made.
Which figure are you looking at there, Emily?
Let's see.
I want the first cluster and the third cluster and skip the second cluster.
So
The
We don't
first
have-
7, the 3 and the 9, right? And leave out 5.
Page 3.
So are we referring to, or I shouldn't say wait, is the committee interested in seeing a table or seeing the line chart?
I think it's always helpful to have both because some of
Okay, so
us
both
like one.
table and
Because
both,
because the line chart is the effective, right?
correct.
These are
Okay.
brackets.
Okay, so we could create from table 1 on slide 3, a line chart with the effective tax rate. Maybe we did it in a previous presentation, but so we would have that table, the report would include that table and the line chart. And
Well,
then also the table 3 on slide 8 and line chart figure 3 on slide 9.
why would we do the 474? That doesn't jive with any of our understanding of renters and all that stuff. So
474 is if we made no policy decisions at all.
I understand that. So,
But we have.
but we have in our report said you need to do this and that. So
I would include it and add language to be clear that it's illustrative to demonstrate the impact of policy decisions
All right.
that were made.
so you would.
So that if then more policy decisions are made, people would realize that other changes of that scale
So when you
might.
come in and say, we've got to do this,
Would it be helpful to include these maybe in an appendix because they're not necessarily committee recommendations to be cited as further materials?
I think so.
I mean, at some level, if the people that care about this, this is what they care about. They're gonna look at it, so it doesn't really matter where you put it, so you're saying table 1 and table 3 or all 3 of table?
Table 1, sorry.
5 and
We
9.
just don't have a line graph for table.
Let me just answer the question. Table 1 and a line graph that goes with it, and table 3 and a line graph that goes with it. I would skip the bar charts just for the sake of not having too many things.
With clear explanation as to why we're
Yes.
dealing with two different numbers.
Yes. And that you're clear, the point of including the first one is to just demonstrate the impact of policy changes.
Okay, you want to put in the 600 million on page 4, which we do have a line graph for.
No.
No,
No,
that's
that
what I
one-
thought.
that
You
one-
want to do 3 and the line graph that goes with chart 3 and chart 5. And the line, and 9 is the chart, the line graph that goes with, no, that's 8.
Tables and figures, now you're throwing in charts.
And page numbers.
I'm
Table
talking
one.
about table 3 and figure 3 and table 1 and a figure that is not in this
Yes,
PowerPoint.
good.
We'll call figure 1.
We're
Yes.
leaving out the middle, the 600.
Leaving out the middle.
I understand.
Yeah,
We got older, and what we're going to have to raise under the policy decisions we're recommending.
Right.
And again, that these are used for illustrative purposes as a reference point to the impact of policy decisions. These are not recommended rates.
And then, is it annoying to talk about the draft bill? Because
Let's just make sure we're totally done with the report before we talk about the draft bill. Do we have other outstanding revisions on the draft bill that we want to talk about before lunch?
For the conclusions.
Before the, yes.
Okay,
Scott, you've been shockingly quiet.
well, maybe
Okay.
helpful, Abby, I've been told you've been working on a bill as close to what we've decided.
Wait, can we please finish the
Okay.
report before the bill? Just so that we.
Oh, okay, what
bring it
part
home.
are we not finished with?
Do we have questions on it? So
Oh, sorry, I misspoke.
Yeah.
I'm sorry. Thank you.
we're talking about.
Okay, so there's nothing else on the body from anyone.
and so we're adding those
We're adding those things.
two lines into the,
And we've made a bunch of edits. And it's possible that some of the clarification from the stakeholders might result in a little bit more extra words somewhere.
just looking through. What did we decide on the circuit breaker?
Ooh,
The municipal,
Yeah.
I thought we,
no change.
I thought,
Well,
I thought
we
the
sort of squished into it earlier.
I thought we decided on the circuit, and this is again, like just what I thought, not what I'm recommending. I thought what we decided on the circuit breaker was that we would go with the existing circuit breaker paperwork and be clear that we hope the General Assembly in all of its wisdom will in the future try to figure out a way to simplify that.
Yeah, okay. I like that. I just hadn't.
yeah,
That's what I have in my notes.
Okay, cool.
okay, that should work.
The,
Could skip the word wisdom. Probably.
the other question I had was on same page 21. We're talking about, this is sort of the catch-all, hey, we didn't talk about TIFs and stuff. And then there's this, and escrow accounts for mortgages. Which just seemed like a sort of funny little add-on. It doesn't seem overly complicated to me, but I didn't know if people really felt that was important to include.
I would
I mean,
include,
it's totally a different scale to me of TIFs. I don't have first clue what we do with TIFs.
Yes.
Escrow, you know, the mortgage companies will figure that out, but
I don't know if they will. So I think just saying the impact on escrow, I guess I would say the impact on escrow. I don't know if I would say escrow accounts for mortgages. But I think, and if we want to add a third one in, we could add in
well, all
the amount
right.
of like dollars that sit in towns' bank accounts, and if there's an impact from that, like, that's another one.
Okay, well,
Make it-
TIFs are state instruments.
Yes.
They have potential huge impact for revenues, and it's really confusing. Escrow is something that people do privately with their bank, so maybe, I don't know, it sounds so ridiculous, but sticking them in the same sentence, it's sort of like, I don't know, it just strikes me as funny, but,
Okay, it did come up and,
okay.
but we're not saying the state, right now, the banks want your property tax escrowed because the town can take a lien on what the bank owns. But if we're not saying that if you don't pay your income tax, the state can take your house, then it doesn't,
There's a lot to be figured out.
Okay,
yeah, it doesn't make,
so I don't have a problem having that in there.
Do you want to add a?
Way, just, that's a different one than what I think of as escrow accounts. But, in terms of, you're talking about enforcement of a school tax liability.
right.
So all valid and understanding if banks have concern about escrow is fine. Just seems kind of a different
They have
scale.
concerns about
than TIFs.
liens.
Can you let it go and we'll just keep that sentence?
I think that the chair has uncovered a good question, which is not covered in escrow accounts for mortgages, which is enforcement mechanisms and what that means for
Well,
liability.
I thought we covered that in administrative
Okay,
stuff, and that we're lining up with the income tax, which has its own enforcement system attached to it.
it's just such a great report, and to have that be our last sentence.
Well, it's not going to be our last sentence.
Oh, well, there you go. All right.
Our last sentence is, so
Read our conclusion.
my assumption is that the conclusion just repeats the stuff we basically said in the introduction. And then we have a next steps, which is our outstanding issues.
Okay.
Yeah, the issues that we
Moving on.
do not have the time to address.
Worried about volcanoes and ruts in my driveway.
Volcanoes in New Jersey.
Earthquakes. Should be worried about earthquakes.
Okay.
Okay,
Does,
do we want to start, we've got 3 minutes before we're scheduled for lunch.
I think we should eat lunch.
Do you think we should eat lunch? I think it might be a good time to take a break, give staff a break. Timing for lunch, I know there's a couple people, when we're trying to get out of here by 2:00. Given the detail of our discussions, it might be good to take a half hour for lunch. Can we do that rather than an hour and come back? We could be really bad and bring lunch in here, but I don't want to.